unless you've got the gloom.
Well, I think the problem that I have with the peak growth concept, and Andrew, I'd love your opinion on this as well, is that the peak rate of growth was always going to become at the beginning of this particular cycle because of the nature of the slowdown. It was a mandated recession, reopen, spring, coiled, bang, you jump higher. For me, I'm not sure that's any indication of where the cycle goes, though, Andrew. What's your take on it?
I think the cycle is going to last longer. This concept of peak, I have a hard time with this peak concept, given the magnitude of the earnings revisions and the blowout so far. So I'm just not sure we're there yet. And so calling the end or calling the peak, I think it's premature.
So let's talk about the potential returns. Let's go to the Jonathan Golub call for 22% returns in 2021. Can we get 23%, 25%? What are you looking for here?
Well, I think that next year's earnings are already up to about $208 from the low 190s at the beginning of the year. So that was the beginning, low, around 190, and we're up to $208. Well, what happens if we get to $220 to begin next year? I mean, I think that 4,300, 4,400 is very doable as a forward PE. The point of this is, I think what's the most important here is we all look at PEs and we base them off forward estimates. And the flaw of forward PEs is what happens if that E is very wrong? And that's what we're seeing this year. The forward PE has been way too pessimistic. So I think that's very possible. We'll see mid 4,000s by year end because I'm just looking at the trajectory of the E.
Andrew, it's good to catch up. As always, Andrew Slimman there of Morgan Stanley. With a little bit of media training for me as well, I think, Tom. I think he's trying to tell me what to ask next time someone talks about peak growth in an interview. Push back, John, push back. You often get this. People have a position and then they want you to push back, and I get a lot of that on Twitter too. There is a difference between saying there is limited upside in the equity market and there is limited upside in the credit market. In high yield, Tom, some of those markets in fixed income are call constrained, which does limit the upside for particular markets within credit. There is a limit to that because of the embedded call in some of those securities.
Yeah, the correlations here between bonds and equities are different. What's interesting is the x-axis of that study, John, where there's a tradition.
Okay, traders, position closed on Japanese yen at 109.410. It took us a little bit time to make profit. As you can see, 9:10 we entered position, it moved down, up, and then we just played stop on profit. We made £500 in about 2 hours. Okay, all of you guys who follow this trade and made a profit, well done, well done. All of you who already got the strategy, you know how to make money, you know how to make profit. So great. If you would like to get the strategy and to find out how to trade other pairs or stocks on margin, please go to company.co.uk website and you will get all the information about webinars, about 15-minute free sessions, about strategy. You can purchase the strategy. It's not free. You have to buy the strategy. We don't give away valuable strategy. So you will purchase, you will get information, you will get live support for live. About if you will have any questions, you can contact us directly and we'll help you to solve your problems. Okay, I'll speak to you later. Stay safe and let's move on. Let's look for another chance, for another opportunities to make a profit from Forex. Stay safe.
And the state of Texas now anticipates an unexpected budget surplus. Tax collections are rebounding along with the nation's economy, causing the state to boost forecasts for the next 2 years. Texas expects to end the current budget cycle in August with a $725 million surplus. In January, the state forecasted a deficit of nearly $1 billion. Saudi Aramco's profits soared in the first quarter after a recovery in global oil and gas markets that allowed the world's largest energy firm to keep its quarterly dividend. Almost all of that goes to the Saudi government. The payout is a vital source of cash for the kingdom. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
What's been quite concerning is that we haven't really seen as much of a global response as necessary. India is in clear need of international assistance, as will other countries be quite soon, if not, now. So I really hope that, countries can look within themselves and figure out what they can do to help.
That was Jennifer Nuzzo there, Johns Hopkins Center for Health Security. From New York City this morning, good morning. Alongside Tom Keene, Lisa Brambitz, I'm Jonathan Ferro. Your price action this Tuesday shaping up as follows. Equities down about 5 points and off a little more than 1/10%. Yields higher by almost 2 basis points to 160-172 on 10s. In the FX market, a small break of euro-dollar at 120 earlier. 120.13 now, down 0.4% in G10. Crude 65.62 on WTI, up by about 1.75%. That is the cross-asset price action. Let's get you some of the earnings. The numbers from Pfizer breaking in the last couple of minutes. A huge upgrade to the full-year revenue forecast. Let me go through the numbers for you. 70.5 billion to 72.5 billion. That's the range now. Previously 59.4 billion to 61.4 billion. And Tom, pretty much all of that is coming from a full-year revenue forecast for COVID-19 vaccines of about 26 billion from 15 billion previously. It's a big upgrade on revenue.
Well, it's a big upgrade on revenue. And again, the background here is the New York Times talking about Pfizer vaccinating down to 12 years old at some point. Here, we get lucky with our analysis in that we have the finance of Pfizer. And with us, Amesh Adalji of Johns Hopkins. John Farrell, let me go to you first. I see a single line item, beautifully laid out, I should say, by Pfizer. They're not hiding anything here, where vaccines go from 1.6 billion, and explode up to 4.9 billion. John Farrell, why don't you bring in Dr. Adalji of Johns Hopkins with Pfizer getting it done?
Well, here's the headline from the New York Times, Tom, that you allude to in the last 24 hours. The FDA to approve the Pfizer vaccine for ages 12 to 15 next week. A report coming from the New York Times. I'm pleased to say that Dr. Amesh Adalji of Johns Hopkins Center for Health Security joins us right now. Doctor, let's just start with that headline. How important is that next step on rolling out this vaccine?
Well, if we're going to get cases down from the tens of thousands that occur every day, we need to have more of the population vaccinated, more population-level immunity. And as we get to children, the older child groups, 12 to 15, are groups that are in extracurricular activities where you see them spreading it. So you will likely get a benefit in terms of closer to herd immunity, more population level immunity, and decreased cases as we get 12 to 15-year-olds. And it will help some of those schools that have been holding out and not going to full in-person learning have less obstacles in their way to do it. So I think this is a good step forward, and I think we'll probably see even younger age groups approved, but probably not until 2022.
Capacity is building out as well. Pfizer indicating they can manufacture at least 3 billion doses in 2022. Doctor, the problems of a couple of months ago are no longer the problems now. It's not about capacity or supply. In fact, this country is now talking about exporting some of their stockpile of vaccines. In your opinion, is the biggest issue that we have to confront right now still hesitancy?
Yes, that's the biggest issue by far. We're basically hit a wall where we're seeing vaccines dip, to 1 million and probably lower than 1 million. People who have gotten vaccinated, the early adopters, those are people who are really enthusiastic about the vaccine. Now we're kind of hitting that vaccine hesitancy, people on the fence, and there are people who are opposed to the vaccine. So we're kind of going at a much slower pace now. I think the Johnson & Johnson pause definitely knocked down the use of that vaccine even after the pause was lifted. So right now we're really just kind of trudging along, getting people vaccinated, but I don't think we're going to see major jumps for some time. It's going to take some time to accrue a large proportion of the population vaccinated, but this 12 to 15 approval will boost that number significantly.
People who've gotten vaccinated have had the experience of the second shot, and everyone always calls each other up saying, how are you doing? Because the side effects have gotten to be pretty well known. Are the side effects, theoretically, for, say, a 12-year-old child going to be worse, given the fact that the stronger the immune system, it seems, the stronger the reactions?
It's hard to make a one-to-one comparison that way. What we know from the phase 3 clinical trial data in that age group was that the side effects were not considered to be very severe. And there are people who get this vaccine and have no side effects. And it's hard to know exactly where a 12 to 15-year-old would fall. But I know that's something that the CDC panel is going to look at, because remember, children are not likely to have severe disease. Children are not likely to be the major spreader. So that's going to be part of the risk-benefit calculation that both the FDA and the CDC do. And that's important to do because vaccines, have a risk-benefit trade-off that you have to look at in each specific age group.
When you talk about the risk-benefit weighing that we're doing every day, there is a transition going on. When do health officials say enough high-risk individuals have been vaccinated that the COVID pandemic can be downgraded to a bad flu and we can go about our lives?
What I think will have to happen is we're going to have to get closer to 40% of the U.S. population totally vaccinated. And I say 40% because that's where we saw precipitous declines in Israel, which is a much more highly vaccinated country, but they still haven't reached herd immunity either. But their percent positivity of tests is less than 1%. So I do think once we get more people vaccinated and you see cases plummet, maybe less than 10,000 or 10,000, you're going to see just kind of a whole rethinking of how we come up with a better risk calculation, how we live with this virus, because it's not going to go to zero. That's a foregone conclusion. It's not going to happen. But we will get to a point where this is something that has lost the ability to cause serious disease at the rate that it can.
Dr. Adelja, the cynics and the non-science crew will say that if Pfizer's minting all this money, they should come to the rescue, to the aid of India. In their wonderful press release, which frankly, folks, I didn't do a word search on, they don't address the catastrophe we see in these other countries. Is the Pfizer vaccine too fancy for the realities of India?
I don't know that it's too fancy, but it's probably going to be one of several solutions. And remember, India is a net vaccine exporter, and they exported most of their vaccine to other countries. They are a maker of the AstraZeneca vaccine. They have their own homegrown vaccine. So this is a question of kind of logistics and getting them the ability to make more vaccines. They can handle the Pfizer vaccine in terms of manufacturing. The delivery situation with Pfizer, with the ultra-cold storage, that makes it more difficult. A 2-dose vaccine is something that's also not optimal. So if they are able to use a single-dose vaccine like the Johnson & Johnson vaccine in India, that would be probably ideal. You could take it into rural areas. So they basically have to have all hands on deck using any type of safe and effective vaccine that's available to staunch what is really an out-of-control pandemic and to get them back online.
Doctor, we've got to leave it there. Thanks for catching up this morning. Some important steps forward, hopefully. Dr. Ramesh Adelja there of Johns Hopkins Center for Health Security. Just to recapture some of these headlines, Tom, re-emphasize them. Revenue at Pfizer, full year. Now the guide is 70.5 billion to 72.5 billion. Previously, they had seen 59.4 billion to 61.4 billion. That upgrade to the full year revenue guide, largely coming from vaccine revenue. COVID-19 vaccine revenue now seems to be about 26 billion, previously about 50 15 billion. Tom, it's a big upgrade to the outlook for Pfizer.
These are very difficult numbers versus the big tech companies. The compare and contrast isn't there. The yield is almost 4%. Dividend growth has been 6.4%. So it's not like they're, beating the drum like Apple, Microsoft, and the rest of them.
Look for profit as well. EPS 355 to 365, Lisa. Previously 310 to 320.
Yeah, just to finish on the theme here of tepid response, these are blowout numbers for a pharmaceutical company. The shares, they're up 1.3%. They're shrugging. Okay, what more can you do for us, John?
Very unique, though, the situation with
Yes,
COVID-19
absolutely.
vaccine and how much money they can make, or rather not make, from actually developing them and rolling them out too. Coming up, Jim Paulson, the Luthold Group Chief Investment Strategist. Looking forward to that chat. It's just around the corner. This is Bloomberg.
Focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
it's pretty simple to recognize that we're in the midst of a boom here in the U.S.
Because there's so much anticipation of this moment that we're fully reopening the economy. So I think there is vulnerability.
We're potentially going to see faster prices, both in consumer prices and wages.
The question is, how long is transitory? Is it a couple of months? Is it a year or 18 months? But it's certainly not long term.
Until the tax changes happen, you ignore them. But the reality is the market's not ignoring it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We have got an earnings boom from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. 10 minutes ago, it was Pfizer, Tom, upgrading its outlook. Right now, in the last couple of minutes, Under Armour joining the party.
It's really important, John, that this weekend of a Nuanced Tuesday and a Snooze Fest Wednesday, onto the jobs report on Friday. You know what, John? For earnings, this week is as important or more important than the tech boom we saw last week. We're seeing these companies in a boom.
On Under Armour, I think the big takeaway, Lisa, in the last week was just the Apple numbers. They knocked it out of the park, and to see that stock close lower, slightly negative on the day, was kind of confusing for a lot of people.
Especially since it was unclear exactly what was driving it. Was it regulatory pressure in Europe? Was it the idea of higher taxes in the U.S.? Look, I want to go back to what Andrew Sliman was talking about, because he said a couple of really important things. Number one, he seemed to endorse Jonathan Golub's view over at Credit Suisse that 4,500 year end for the SPX seems like it's actually doable. Not only doable, but more and more likely. But also, he noted this 11% miscalculation on the SPX earnings, that basically this is how much Wall Street underestimated earnings. And he couldn't understand why there was no humility, to use his word, but why there was no reckoning for that. Why there has not been any material recalculation of some of these expectations. That's a good question.
Well, Wall Street has a message for its staff. Let's get back to the office. Sri Natarajan reporting for us. Natarajan reporting for us on Bloomberg News right now that Goldman is set to tell employees that they should be prepared by mid-June to work from the offices again. This is according to people with knowledge of the matter. Get back to work seems to be the message, Tom Keene. The investment bank is planning to tell employees that they should be prepared by mid-June to work from the offices again.
Well, that's financial management, and of course they can use their Bloombergs at home or they can use their Bloombergs in the office, John. It differs from what we hear from tech as well. And at Lisa's point, John, on Apple, and I don't know what the return to work game is Apple. Maybe one of the reasons Apple 12 months trailing up 80%. That's
been terrible, hasn't it?
It's terrible.
Brutal.
It's been really tough.
But you know, I'm sorry, but the markets, the expectation function, the algebra of how the stock market works, this is really important. There's an expectation on the left of the equal sign, and there's an expectation on the right of the equal sign. That's one of the few equations that has that. Stocks look forward. It's religion, John, like Twins baseball in Minnesota.
Have you got a comment on the return to work on Wall Street, Tom?
Yeah, I'm not surprised. Paulson wants it. Diamond wants it. Full disclosure, I think I can speak for Mr. Bloomberg. He wants it. Everybody wants it, John.
I think Mr. Solomon called it an aberration, Lisa, the work from home.
Yeah, well, and this talks about the divide between the U.S. banks and the European banks. We've seen European banks say, work from home as long as you want, and we'll get rid of office space and cut costs. And U.S. banks saying, actually, there's a really important, there's importance to having everybody in the office. You know, the people who I speak to when they go back to the office, John, they might not like the commute. But there is a niceness about being separated. It's a fantastic Nuance Tuesday, being separated with work and home and being the being next to the
dare
water
I say,
cooler.
being away from the family.
John, Deutsche Bank.
Dare I say it?
John, Deutsche Bank had a great chart yesterday.
What was it, Tom?
I think it was redone in Zero Hedge. All these reasons about work from home, blah, 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 blah. The number one by a country mile was the stress of commute.
I agree with you.
That's all this is about.
Sure. But the likes of Goldman, the likes of JP Morgan have got a pretty strong message, Tom.
The three of us.
Let's get back to work. The commute's coming back.
I mean, the three of us don't know what we're talking about because we're all getting fancy pants driving services and that, you know.
You might be. You might be.
You know, I'm sorry. But,
Speak for yourself.
I still can't figure out how to put the window down in the back seat of the Bentley. The driver has to do it.
Have you noticed the Uber times in New York City at the moment? Trying to get a car is really difficult.
It's gotten difficult and the price is up.
Price is up.
Yeah.
Times are getting longer. It's a bit like a PMI. an ISM, Lisa.
Somebody
getting
has
an
a
Uber in
violin.
America, in New York.
Someone has a violin out for us.
I'm not asking for it, but I'm just indicating the demand.
No, it's true.
Just a little
And it's a
anecdote
good
about
point.
the demand in New York City
And
right now.
It's a good point. And if you try to rent a car, if you try to get a car, if you try to get on an airplane, if you want to take a domestic holiday to Hawaii, all of the costs are getting jacked up dramatically.
Yeah.
You're absolutely right.
This went on way too long. Here's the price action. 41.83 on the S&P 500. We're shaping up as follows. Futures down almost a tenth of 1%. Yields are higher by a couple of basis points. Lisa, no drama. 162. Euro dollar, brief break at 120. Right now, euro dollar 120.14.
All right, let's get through the data today that we're looking at. 8:30 a.m., we're going to see that record trade deficit. That's the expectation. The U.S. importing way more than it is exporting. A lot of the money going over to Asia, in particular, for some of the goods that everyone is buying. Then 10 a.m., we get factory orders, durable goods orders, this idea of the demand really driving some of the chip shortages, some of the ongoing shortages that John was rightly talking about. And it's actually a really important point that everyone has seen when they try to go get hiking boots, for example, and they can't find any in their size because there are not enough supplies out there, and there has been a rush of demand. And today, G7 foreign ministers are meeting yet again in London, discussing perhaps travel in between the Atlantic corridor, or possibly even some sort of collaboration in how to address China. That's the other topic that has been on the table, John.
Lisa Brambis, thank you. Jim Paulson joining us now, the Luthold Group Chief Investment Strategist. He wants to travel too, maybe between London, New York, get back to work. Jim in the office, Goldman telling the staff at some point in the next few weeks, maybe that's the case. Jim, for many people in the markets, this is the moment we've been anticipating, building up towards. It's why we positioned in the cyclicals in early November when that first headline dropped about vaccine efficacy and the rollout was just around the corner. Now many people are asking, Jim, is it done? Is the cyclical trade done? Just as the get back to normal story really starts to build, is it, Jim?
Well, you know, Jonathan, they've had a nice run here, there's no doubt, and people are concerned, as you said, about, you know, we're going to reach peak growth here soon in the expansion, probably year on year at least, peak growth, and we're also have had a nice run, and stocks are forward looking. We're probably due for a correction at some point. All these things are true, but when I look at cyclicals, where they are today, the relative total return of the four major cyclical sectors of the S&P, their level is lower than 85% of the time as you go back to 1945. They're closer to where we look historically at recessionary lows than expansion highs, and I think they still have quite a bit of room left. They're priced today relative to the overall market where they were, let's say, in the early 60s, where they had almost a 12-year run of outperformance going up to 1972. They're priced comparably to where they were in the early 80s, where they went from 80 to 89 outperforming, in the early 90s, where they outperformed from 90 to 95, and even in the early 2000s, when they outperformed from like 2001 to 2007. So I think there's more room here for the cyclicals. I also like the environment around them, too, in the sense that, just think about this for a minute. Cyclical stocks are highly correlated, their relative performance, to three big things: to commodity prices, to bond yields, and to a weak dollar. And at least two out of those three, there's not much debate. Everyone kind of knows yields are going to go higher, commodity prices are going to go higher. I personally think the dollar is going to go lower, and all three of those would mean that cyclical stocks still have more upside. So I would continue to hold them. You got to kind of hold your nose. They're volatile. They're not like owning buying and holding a defensive steady Eddie stock or a growth stock, but I think they can do good things for your portfolio here in the next few years.
Jim, have you been upgrading your expectations for returns on U.S. equities based on some of these revisions upwards in full-year forecasts?
You know, Lisa, I had at year-end, I had a $200 estimate on the S&P 500. That's still kind of where I'm at. And so I think the street is continuing to come up. You know, one of the things that we've had happen, if you look at the Bloomberg Economic Surprise Index, it has been in the upper quintile of its range since 2000, 80% of the time in the last year. It's never done that. And what that really tells me is that surprises have chronically been better than expected. Even though people are revising up their expectations, they still can't revise them up fast enough or aggressive enough because the economy and earnings are coming in even better. And every day the surprises keep coming in better than expected. People have to raise their earnings targets, raise their price targets for the stock market, raise their targets for GDP growth, and I think that's chronically happening. Now, we're going to eventually catch up. I agree with that, but I still think that the street is behind it. I think the Fed is talking about 6.5% GDP. I think we're going to have more like 8 to 9% this year, and the street's around $180 on earnings, and I still think we're going to do 200. So I still think there's room. But to Tom's point earlier, the market's a forward-looking animal to some degree, so you still have to question how much of that might be in the market.
Hey, Jim, it's always great to catch up, and it's good to see you. I believe back in the office, too. So welcome back to the office, Jim. Thank you, sir. Jim Folson, the Luthold Group Chief Investment Strategist.
Transitory.
Do you have the in-the-office glow, Tom? Is
No,
that
the
what
Twins
it brings
won.
with you? The glow. The
Twins
won.
are horrific
Okay.
this year. The Minnesota Twins beat the Texas Rangers last night. That's the only reason Pulse has got a glow.
There's your ice hockey talk.
Yeah.
Baseball, I'm
It's
joking.
baseball.
Coming up, 8 a.m., Seema Shah, Principal Global Investments Chief Strategist. That's got you every single time for the best part of a decade. Futures down 3 on the S&P. We're down by 1/10%. From New York City for our audience worldwide. Tom Keene, Lisa Abramovitz, Jonathan Ferro, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. In Mexico City, a raised subway track collapsed, plunging train cars with passengers aboard to the ground. At least 23 people were killed and about 70 others injured. The accident is blamed on a broken beam. The subway line that collapsed opened in 2012. The project suffered from design problems during construction. Wall Street's march back to its skyscrapers is picking up the pace. Bloomberg's learned that Goldman Sachs is planning to tell U.S. employees they should be prepared by the middle of next month to work from offices again. That follows J.P. Morgan's mandate last week for a return to offices in rotation starting in July. Pfizer raised its forecast for fiscal year and said coronavirus vaccine revenue will be much higher than expected. The drug maker expects vaccine sales to hit $26 billion. That's up from a previous estimate of $15 billion. Pfizer's first quarter sales and profit beat estimates. And CVS posted first quarter earnings that beat estimates. The drugstore chain also raised its earnings forecast for the full year. Revenue for CVS's health insurance business was up almost 7%. A fortune valued at $146 billion is at stake in the divorce of Bill and Melinda Gates. The couple announced that they are splitting after 27 years of marriage. They made no hint of their financial plans, though they emphasized that they will cooperate on continuing their philanthropic operations. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It seems as if the Fed has been somewhat overtaken by events. It will stay accommodative. Chairman Powell has said again and again, we aren't even thinking about raising rates or tapering. But my sense is the amount of fiscal support that's underway and the strength of the economy will probably, force the Fed to perhaps rethink what it has laid out.
Really interesting comments from Rangaram Rajan there, the University of Chicago Booth School of Business professor and former Reserve Bank of India governor, with some scathing words for his home country as well, Tom, which we can touch on a little bit later. From New York City this morning, good morning. Alongside Tom Keene, Lisa Brambitz, I'm Jonathan Ferro. Equity futures are down 3 to 41.82 and off by almost 0.1%. Yields are higher by a little more than a basis point to 161.37. Euro dollar had a little break at 120 earlier. It's north of that level again at 120.11, up 0.4%. And crude has a 65 handle, 65.57 on WTI, up by 1.67%. Talked a lot about the numbers here in America, the vaccinations, the improvement, the steps forward. Well, the vaccinations, I'll get my words out, have been rolling over recently. There's been some concern, but here in New York City, we will reopen, Tom. Even more so, we will drop the restrictions, the capacity constraints, I believe, on May 17th. You compare and contrast that with the headline that just crossed from Singapore about 10 minutes ago, planning a 3-week COVID crackdown with groups limited to a maximum of 5 people. Two different worlds still, Tom. Very different experiences.
Two different worlds, and you compare it to Tokyo as well, as they had the Olympic pressures. It's just extraordinary, the different worlds that are out there right now. In Washington, there's only one world, and that is, well, the election in 2022. That's always the story in Washington. Emily Wilkins joins us now, Bloomberg Gridlock reporter. Emily, Greg Villiers out with a sharp note where, it's not certain, but Democrats really struggling to get to a House majority in 2022 with retirements and et cetera. What does a before Gridlock Biden look like? What does the president look like? What's the new urgency from Ron Klain and the White House given these political realities?
Well, I think the White House realizes that if they only have 2 years of having Democratic majorities in the House and in the Senate, they better get to work and do something that they can make sure to run on in 2024. I think that's what you are seeing with this $4 trillion economic plan that's been proposed. The idea is do something big, gives Democrats something to run on in 2022. You're absolutely right, Tom. I mean, yes, the cards are stacked against them in terms of redistricting, in terms of historical. Usually it's the minority minority party that winds up winning big in the midterms. Democrats don't have a lot of seats to lose. But I think there is hope. When I talk to lawmakers on the Hill, they say, look, if we can get this big bill package passed, we can at least go back to our districts and say, hey, look at what we were able to do for you. Please reelect us again in 2022.
I've heard a number of Republicans the last few days talk about the idea, okay, you're going to raise taxes on the 1%, the 2%, whatever the number is, and that also means you're going to raise taxes on everyone else as well. Explain that nuance to our audience, particularly our international audience, where the opposing party is selling the idea you can't trust a certitude that just the 1% is going to pay the bill.
I think the position for Republicans for decades at this point has been that if you are taxing those who are the job creators, who are the ones who have the companies, who are the ones who, yes, might be wealthier because they started the company and now they're CEO or the president, if you tax them, they might decide to move those companies elsewhere and those jobs elsewhere. I mean, at the end of it, this is what we saw with President Biden's speech last Wednesday, right? Jobs, 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 jobs. That's such a key word, I think, for both parties at this point. And Republicans are hoping to tie those tax increases to a loss of middle-class jobs and middle-class Americans, which is both parties are trying to target right now. That's why when you saw President Biden go down to Georgia last week, when you heard him talk to Americans, he's really trying to portray this as we're raising taxes on the rich and only the rich. That's why he had that line about having no one who made less than $400,000 is going to see a tax increase. Of course, now we know that's a little bit different for married couples in there. But he really is trying to portray this as an increase on the wealthy.
Emily, if I had a script, I'd rip it up as per Tom Keene. I wouldn't go to what John was talking about, these 5 new community cases in Singapore that prompted a 3-week COVID crackdown with groups being more limited and restrictions being put in place. We're still reporting thousands of cases in the U.S. We're not anywhere close to being concerned about simply 5 cases. That would be an absolute victory. We would call the pandemic over. Where is the pressure in Washington, D.C. when it comes to reopening or cracking down? Because that was such a huge focus under the Trump administration.
It's interesting, Lisa, because we are seeing states at this point be the ones, again, as we kind of saw in the Trump administration, to kind of say we're going to open up or we're going to crack down further. I mean, yesterday we saw Florida Governor Ron DeSantis go ahead and say that he's lifting all COVID restrictions in the state, including those that cities and localities have enforced. But as you guys pointed out just a few minutes ago, we're also seeing New York City get ready for return to normalcy, as well as a number of other states. So I think there's a sense of how do we do this? I mean, we've seen the CDC already come out with new guidance for those who have vaccinations, clarifying about when people who are fully vaccinated do or don't need to wear a mask. I think really the pressure in DC right at this point is to make sure that Americans are getting vaccinated. How do you convince those Americans, and there are many of them out there, who don't think that they should get a vaccine either because of health reasons or other concerns? How do you convince those Americans to get a vaccine? And I think that's something that's being worked on at the national level, at the state level, and at the local level at this point in trying to convince those holdout groups to take this shot.
You know, I got to say, John, it seems like there is increasing dissonance right now between the states and the federal government when it comes to the pressure of whether to reopen faster or whether to crack down for longer and try to get the virus counts down lower. It seems like that tension is only growing.
When it comes to hesitancy, I think it's pretty clear. Last week, I believe it was last week, it feels like a month ago, the president leans into the camera with a microphone and says you don't have to wear a mask outdoors anymore if you've been vaccinated. That's a reason to go and get vaccinated. And Emily Wilkins, I think myself and many other people just felt that was so out of touch with the moment, because for a lot of people, that's not enough. That's not life-changing. Do we need more guidance? Do they have the science to back up that guidance? And where is it?
Well, I know the CDC is expected to come out with more guidance as higher percentages of Americans begin to get vaccinated. So yes, absolutely. We're going to be seeing more guidance from the CDC and more guidance from the White House. But look, even at the start of this pandemic, this was widely something that was state-led. And even though the Biden administration is really trying to nationalize the message, to a certain extent, this is still something that is state-led. When it comes to these specific regulations, Joe Biden's not up there being like, okay, hey, we need to, lock down Los Angeles and open up New York. This is something that's really at the local level, and really the job of the president right here is the messaging component and trying to convince individuals to get that vaccine shot.
Emily, thank you. Emily Wilkins, Bloomberg government reporter. Tom, did you see yesterday Governor Murphy talking about pints of free beer if you go and get vaccinated?
Yeah, I mean, we're opening up, and it's clumsy is what I see nationwide. I mean,
a beer gets it done.
Transitory.
You know,
I'll reserve judgment on that. Up next,
I
Ian
think he
Lincoln
offered
there,
Schaefer, a beverage.
This is
a
Bloomberg.
New Jersey beverage.
Surveillance live from New York City for our audience worldwide. Here's the price action this Tuesday. We decline by about 0.1% on the S&P 500. No real drama on futures. We come in about 1/3% on the Nasdaq 100. I want to talk about the bond market just briefly. So switch up the board. 2s, 10s, 30s. In the bond market this morning, a really thoughtful note published by the rates team over at HSBC. The idea being that maybe the deficit peaks pretty soon, and we've already locked in a lot of the issuance at the longer end. So long-term debt auctions could fall as well going into next year. They think that's one of the reasons why that should back up their call for a 1% 10-year yield year-end this.
I'm going to place a new order to sell short euro. The price I'm looking to sell 120, 105. Okay, order placed. So if you want to trade, position opened right now. No, not yet. I'm looking right now to my trading screen. It's still, I still did not open position. So many orders placed at this price. I'm still, even as you can see, chart shows that position open, but not with order I placed. And I'm still waiting. Okay, let's wait. And no, still in. Okay, position opened at 120, 105. So if you're looking to sell short, please follow this trade and place an order. You still have time. And I will guide you through the same way as we did with Japanese yen. I'll speak to you later, guys. Stay safe.
You know, it depends. He's got, you know, he's on
news
the
this morning,
the beach, and
that Goldman might get the message, and it was Sri at Bloomberg News that is telling them this, because as far as I'm concerned, as far as I'm aware, Tom, the letter hasn't been sent out.
Sri's
so the
way out
investment
front.
bank over at
Sri's
Goldman
hardwired into
have got this
Goldman
letter prepared to send out to the staff, and we're breaking that news this morning.
We should people like Mark Gurman covering Apple, Sri covering Goldman Sachs, Romain
Sri
covering
is to
the
Goldman
street.
what
I mean, these people
Gurman
are
is to Apple.
Romain is just wired
Romain
in.
is to stocks.
He's like locked in.
Romain's here right now. Let's get some movers. Morning, Romain.
Hey, good morning. We did get some earnings this morning. Of course, Pfizer. Interesting results here from Pfizer and CVS Health. Pfizer actually still benefiting from the COVID crisis. This is a company here that came in above estimates on the revenue side by about $1 billion, and then actually raising its estimates, its full-year revenue estimates, probably about $8 to $9 billion, above what it had previously forecast, about $8 to $9 billion above what the street was looking for. A lot of this is because it expects to make more money off of those COVID vaccines than previously expected. On top of that, its non-COVID drugs actually doing pretty well. Meanwhile, CVS Health, it actually did report a pretty interesting bump up in revenue growth, but a lot of that had to do with raising prices on some of its prescriptions products. It's actually still being hurt by the COVID crisis because a lot of people really still aren't coming into that store. They're not buying sort of that, what they call front of the store merchandise that they would normally sell with all of that foot traffic. So that's still weighing on them going forward here. And then an interesting move here in Twitter. You're starting to see a lot of activity here among Elliott Management and Cathie Wood's ARK funds buying into this dip. This is a stock now down 19% over the past 6 days. We continue to see buying coming in, and now Bloomberg reporting that not only has Elliott bought into that dip, but apparently they're out there really sort of rattling the cages of some of the other hedge funds, saying they should be buying into this dip as well. Flip up the board. I want to show you here what's been going on. We don't talk about ag commodities enough on this show, so I'm going to introduce this onto the show. Bunge actually up 2.4% here on the day. Interesting move here. They're really benefiting from a lot of this crop price inflation. Of course, this is one of the biggest commodities traders and processors out there. Meanwhile, you have Mosaic, which is on sort of the flip side of this equation, really being hurt here by a lot of these higher raw material costs. Of course, Mosaic, a big fertilizer maker, those shares down 5% here in the pre-market. And then you have Kroger getting a downgrade over at Goldman. Albertsons also being downgraded in that move. Those shares down a couple of percent here because of a lot of that commodity and raw price and raw materials inflation, saying that companies like Albertson and Kroger aren't going to be able to pass that on.
Romain, I saw DuPont. Citigroup had a constructive note on DuPont, and what was important to me was their underestimation of Asia-Pacific growth. They made real clear Asia-Pacific growth has been the variable for international companies. Do you see that?
Absolutely, and we actually had Jim Fitterling of Dow on a couple of weeks ago who was saying this exact same thing. Remember, they were also hurt by those rising commodity prices, but then he said, look, when you look at the demand, the aggregate demand coming out over in Asia as well as in Southeast Asia and even some parts of the Middle East and Africa, he said, look, that's enough to blunt the impact of some of those higher costs.
Romain Bostic, thank you so much to close this afternoon. Right now, one of the most anticipated morning notes on the street, Ian Lingen with BMO Capital Markets writes an acutely direct and line-by-line exquisite note on the state of fixed income. He joins us, head of U.S. rate strategy. Ian, I love how you framed Friday's jobs report is the what now jobs report. We're going to get 1 million jobs, and then there's the what now of it. Describe that.
So, first of all, thank you very much for that wonderful introduction. I appreciate the kind words. That said, we are at a pivotal moment for the Treasury market. We are at a pivotal moment for the reopening narrative. And the fact of the matter is, we have brought forward a lot of the upside, the vaccine rollout, whether one believes we have any chance of reaching herd immunity at this point or not. It has been accelerated, and we are at a what now? What happens if we get a 1 to 2 million NFP print and we still rally in treasuries after the fact, which is a very real possibility. People are just looking past the initial stimulus-inspired growth in the first half of the year, and they're looking toward what happens when we are reopened. And it's not going to be a situation where the limiting factor is simply reopening a business. The binding constraint is individuals making the decision to go back out and engage in in-person commerce. Yep. And we as a market just don't know how that's going to play out.
So, Ian, from your perspective, just to add to this, what's the balance of risks around treasuries going into Friday? Is it asymmetric? Do we respond more to a downside surprise than we do an upside one?
I do think that it is asymmetric, and a disappointment will have a more bullish impact on treasuries than an upside surprise. And part of that simply because as a market, we lack context for the magnitude of these numbers. We just need to see them go the right direction.
So what does that mean for the big call in this market right now is that we can get somewhere close to 2% by the end of the year. If we can't get a trajectory higher off the back of numbers like this, Ian, what takes us there?
I mean, if we can't get a 2 handle in the first half of the year, it's going to be very difficult to justify getting 10-year yields above 2% before the absolute end of the year when the market starts seriously considering and pricing in tapering.
Meanwhile, Ian, there is the supply-demand dynamic. John was mentioning earlier, HSBC came out saying that there was likely to be a peak issuance when it came to treasuries this year. Other estimates have it at $2.7 trillion of net issuance for 2021, and that it would slow thereafter. How much does this matter in terms of putting a support on yields, basically that they can't rise as much because the supply will come down, versus allow the Fed to taper and reduce their participation in some of these auctions?
I would argue that the bigger issues at play in the Treasury market really are the macro outlook, not only domestically but globally. That said, on the margin, curtailing supply will be net positive for Treasuries. It will limit how far 10-year yields can back up. And if we do get above 2%, it will put a limit on how long we stay there. That said, the bigger numbers in terms of Treasury issuance on the net issuance side are behind us. And if that was actually going to feed into the bond vigilante argument, we wouldn't be having a conversation right now with 10-year yields at 165. We'd be having a conversation with 10s closer to 2.5.
So what would it take with respect to inflation data, if that is the main metric that's going to drive yields from here? What would you have to see to push yields higher than 2%? Because you were saying it's hard to see that in the near term.
Well, one of the big issues at play at the moment is that the Fed is dismissing and is forward dismissing any increase in inflation as transitory. And as a market, we're spending a lot of time arguing about what the definition of transitory should actually be. From our perspective, it really comes down to what the Fed says it is or is not. So to get yields sustainably higher, we would need to hear the rhetoric from the Fed change to this is actually true cyclical inflation that's not transitory and is here to stay. And that would recast the market's expectations for how quickly we move on to the next stage of the cycle.
Ian, we've got to leave it there. It's always good to catch up with you, sir. Ian Lingen there, the BMO Capital Markets head of US rate strategy. On the recent communication with the Federal Reserve, this came from the New York Fed President John Williams in the last 24 hours. Later later in the afternoon yesterday. My expectation is that once the price reversal, short-run imbalances from the economy reopening have played out, inflation will come back to about 2% next year. They are willing to wait. Tom, that's the story here, isn't it, for the Federal Reserve? The patience. They are willing to wait to see if they are wrong. And if they are wrong, they're not going to find out potentially until year-end, the start of 22. And that's essentially what Vice Chair Clowder alluded to us on this program a couple of weeks back too.
And he's got a little bit of economic history on his side. Richard Clarida is extremely smart, as is Adam Posen, is another name, John, at knowing their Fed history. And the Fed history is they're always exposed. I know I sound like a broken record, but the answer is they're going to wait. The question is, John, which inflation index? I would watch the Atlanta sticky CPI series, and also I've for years I've adored the Cleveland Fed Index, which is an adjusted core index.
I know you like the Cleveland Fed Index too. The other interesting comment here from President Williams, Lisa, was also just the international aspect to this, the global perspective.
Fair, yes.
Hadn't heard that very often from Federal Reserve officials over the last several months. We're seeing a slower rollout of immunizations, emerging strains of the virus, and a more subdued rebound in other parts of the world. This international context is another reason why a complete U.S. recovery will take time to achieve.
And it's reality, right? I mean, the world is globally intertwined, regardless of a more nationalistic kind of approach in the recent years. I do want to just say, though, on the front of inflation picking up, manufacturing data coming out. What if production picks up, then it all comes online, demand declines? You could get to this idea. Back to slow inflation.
Futures rolling over. We're down 23 on the S&P.
Disinflation.
We're down 0.5%. We roll over 0.55% into negative territory on the S&P 500. Yields come in too. A break of 160 on 10s to 159. Just in the last couple of minutes, this market's turning. More still to come from New York. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. Treasury more than quadrupled its borrowing estimate for the quarter through June. It expects to need about $1.3 trillion over the second half of the fiscal year to pay for new pandemic relief spending. The latest wave of stimulus payments sent the budget deficit to a record in the first half of the year that began last October. The state of Texas now anticipates an unexpected budget surplus. Tax collections are rebounding along with the nation's economy, causing the state to boost forecasts for the next 2 years. Texas expects to end the current budget cycle in August with a $725 million surplus. In January, the state forecast a deficit of nearly $1 billion. And the coronavirus may be around longer than many people believe. We spoke to the chairman of Moderna, which makes one of the vaccines.
This virus may well end up taking on an endemic character in the sense that there may be enough variants that we start seeing some form of it in various kind of seasonal fluctuations. So, you know, it's not a sure thing, but it may well settle into a behavior that's similar to seasonal flu.
Moderna is now testing lower dose vaccines in an attempt to boost the supply. Saudi Aramco's profit soared in the first quarter after a recovery in global oil and gas markets. That allowed the world's largest energy firm to keep its quarterly dividend. Almost all of that goes to the Saudi government. The payouts a vital source of cash for the kingdom. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Today we announced a major reopening of New York State on May 19th. We've been working with a coordination plan, especially on the tri-state area. And what we've agreed on a regionally coordinated basis, beginning Wednesday, May 19th, most capacity restrictions will end across the tri-state area.
That was Governor Cuomo of New York. I want to turn to the price action right now. In the last couple of minutes, just a little bit of a rollover on the S&P 500. Futures down about 0.5%, off by 20 points. Tom Keene, this headline crossing the Bloomberg. Chinese military aircraft entering Taiwan's Air Defense Identification Zone on May 4th, which is, of course, today. Futures down about 0.5% off the back of this headline as it crosses. I want to turn to the bond market briefly, Tom, and show you what's happening elsewhere. If you switch up the board, yields were to break at 160 again. So yields were higher on a 10-year maturity, now basically unchanged on the day at 159.95. And just to repeat that headline, Tom, because a lot of people scratching their heads about a price action of the last 10 minutes. On the Bloomberg terminal, a headline crosses that the Chinese military aircraft entered Taiwan's Air Defense Identification Zone today.
Well, today, and it's happened before, I believe this is the 11th incursion. We'll have much more on that. It's a larger zone. Many nations have these zones, John. They're not uncommon. This goes back to the U.S. setting this up just after World War II. But certainly it's been something that has occurred before. We see it now. And, John, I would note the real yield, negative 0.80, spikes down to negative 0.83. So it's a correlated move with some dollar strength.
Yeah, and it gives you some indication as to what investors are nervous about right now, the tension between China and the rest of the world over what happens next in Taiwan. So let me repeat the headline for you, and then I'll go through what's happening in the markets. The Chinese military aircraft entering Taiwan's airspace. The price action off the back of that headline pretty clear, down about 0.5% on the S&P 500. On 10s, Tom, just briefly, a break of 160 on a 10-year Treasury yield.
Yeah, well, the yield comes in again, and I'm going to make it real clear to people as we struggle with this. One headline instituting this, and it's out on Twitter, et cetera, is this is a clearly correlated response, John Farrow.
Couldn't agree more. Lisa, your take?
It shows where the bias of markets is right now. We're getting incredible earnings, and there is the potential for some sort of disruption in the South China Sea, and that has greater weight on markets, and that says a lot, John.
Couldn't agree more. couldn't agree more on a range of issues right now. We need to work our way through these headlines. I'm going to repeat them for you, just in case you're just tuning in to try and understand what's happening in the market at the moment. We are down about 0.5% on the S&P 500. A headline crossed on a Bloomberg terminal that a Chinese military aircraft entered Taiwan's airspace today. Equities lower, yields correcting just a little bit. A brief break, a mild break of 160 on a 10-year. Want to get you some stock movers as well. Let's say good morning to Dave Wilson, our stocks editor. Morning, Dave.
Good morning, John. You know, I'm focusing in on consumer staples today because that's the focus of my chart of the day, really looking at dividends. And it's something that Julian Emanuel, who's the chief equity and derivatives strategist over at BTIG, pointed out in his latest research note, specifically looking at the dividend yield on the S&P 500 Consumer Staples Index. So we're talking food, beverage, tobacco, household products, comparing that with the S&P 500. And you see the chart. I mean, we're at more or less historic highs in terms of that dividend yield gap. And in fact, you go back a couple of months to the beginning of March, you saw the differential at 1.5 percentage points. That was the widest in the history of the Consumer Staples Index, which goes back a little more than 30 years. So, you know, at the moment, you're still at about 1.4 points. And for Emmanuel, that's enough to, at the very least, make it worth looking at these stocks. So he turned neutral as opposed to recommending that investors underweight them. So, you know, take that as you will. But, you know, it's interesting to see this sort of gap open up, especially at a time when you're talking about the S&P 500 dividend yield below 1.4%. We've seen corporate bond yields come down. So it's still a matter of where you find income, even as interest rates are rising. And so at least for Emmanuel, one place that's worth looking at and considering is, you know, the makers of these consumer staples.
I saw the same note, Dave. The pricing power, that's an area where maybe that particular sector's got it. Dave, we've got to keep it short, unfortunately. I'm sorry. Got to turn back to this price action. Tom, equities off by about 0.4% off the back of that headline that a Chinese military aircraft entered Taiwan's airspace.
Yeah, you go to the deepest markets here, and that's always a 10-year yield. I'm going to bring it up right now. Intraday, maybe we'll bring that up, or we've seen a spike down under a 159, and we've bounced back, and we'll see how this unfolds.
Can I just say, John, from Charles Rutsky over at Mizuho, coming out saying that it's not the China-Taiwan headline, that China's been entering Taiwan's airspace on a daily basis, and basically it's not the Ferrari headline either. Again, the point being
Well, it's
here...
certainly not the Ferrari headline. Let's be clear about that. And I agree, so let me be clear about this.
Yes.
This is something that happens often. It's our job sometimes just to say, here's the headline, and this is what the price action is. It's not for me to say whether it should be down or should not be down based on what the headline was. It's pretty strongly correlated in terms of the time. That doesn't imply causation. It's just that's where the headline came out, and this is where the price move was, and it was basically at the same time.
I used correlation and causation last night with Afterthought. That didn't go well. Didn't go well at all. Right now, Sri Natarajan with us on Goldman Sachs. Of course, he's been absolutely wonderful on the travails of Fortress Solomon. Sri, real simple. Are the employees going to return for David Solomon?
At this point, it looks like they might not have very much option, Tom. The return to office drumbeat is certainly getting louder out there. We had JP Morgan chief Jamie Dimon come out with a memo for his staff last week, essentially saying that all his workforce will have to be back in the office by July. Of course, they will implement a rotational schedule because those are the CDC guidelines right now. The occupancy is still capped at 50%. We expect Goldman to come out with an announcement for its workforce, asking them to be ready to return to the offices by the second Monday of June.
Sridhar, do you have the sense that bank officials feel like people have not been very productive at home?
Especially when it comes to these two banks, JP Morgan and Goldman Sachs. Throughout the course of the pandemic, we have sensed both from their comments internally and some of the public comments that Jamie Dimon and David Solomon have made, that they haven't been all too pleased with the occupancy rates in their office towers. Both the chief executives have been in the office every single day through the pandemic, and clearly it seems like they would like to see the office buzzing again. And till now, they were taking a much more lenient stand, but with vaccination gaining speed, I think they're ready to lay down the law.
Sri, we've got to leave it there. Great reporting, as always. getting in front of the executives, actually sending out the emails. Sri Natarajan there, senior reporter for Bloomberg covering Goldman Sachs. Equities just recovering a little bit. We're down about 1/3 of 1%, Tom, on the S&P 500. We're down about 15 points.
Well, it was a nuanced Tuesday, and then all of a sudden it's a little exciting off of headlines. That happens in any kind of bull market. But again, John, using the 10-year, the deepest market, we go 159, and we've bounced back right now to 4 digits, 1.6066.
Up about a basis point.
Yield.
Up about a basis point, Lisa. A mild move, no drama.
The idea here, though, that the balance of risk seems to be downward for markets amid a slew of better than expected, better than good, to quote Tom, earnings reports. Still, people looking to the downside.
Very much so. And to your point, this is a headline we've seen before. You're both making that point. But it is interesting that off the back of that headline, you actually get a move this time around. Just points to a little bit of nervousness around a couple of issues. Once again, it is not my job to say why a market should or shouldn't, what it should or shouldn't do. But it's not what we do. Here's the headline. Here's the price section.
We're near
do
a
what you want
correction
with
state.
it. There we go. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news: Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season. Friday is Jobs Day on Bloomberg Television. Will the unemployment rate continue to fall, and how will markets react? The surveillance team breaks down the numbers. The April jobs report, Friday morning at 8:30 on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change,
Bloomberg Green has you covered.
It's pretty simple to recognize that we're in the midst of a boom here in the U.S.
We're potentially going to see faster prices, both in consumer prices and wages.
The danger is that we move into this period of elevated inflation because of the margin spike when everything reopens.
The question is, how long is transitory? Is it a couple of months? Is it a year or 18 months? But it's certainly not long term.
There's no question in my mind we're going to have a pullback at some point, but I don't think it's in the near future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television worldwide and across this nation. Bloomberg Surveillance, an eventful day. Yes, a flutter of news moments ago, moving stocks down, linkages to yield lower. We come back from that. But, John, I got to focus on the elephant in the room. Friday, I'm looking at the Bloomberg survey median estimate, 995,000. Average estimate is 1.034 million. That's a boom economy.
You've seen the top end, north of 2 million over at Jefferies, Tom. These numbers are staggering. They're huge. And demand is so big right now. What's the problem we've got? Actually hiring people. Tom, staff shortages. They're the issues we've got at the moment. We saw that in the ISM, the PMI, yesterday. The struggle is meeting that demand. That's the big issue.
I know the Tisch family over at Lowe's Hotels, John, talking it up. I saw a Bloomberg conference call out on Twitter on that where they're talking about they can't find labor and they're going to have to pay more. John, from where you sit, is the inflation worry entrenched now?
Not yet. Not yet, and I'll tell you why, and I think this is good news too. There is consumer price tolerance out there. They're able to process and digest higher prices. These companies have been able to take on these higher costs and pass them on and maintain margins. We'd have a different problem if that wasn't the case. But so far that is the case, and so far so good. And I think there's an appreciation that the supply side of the economy will adapt and adjust in the months to come.
This is
the demand shock right now. Then we've got to adapt over the next several months.
This is so important what John walked through, the supply-demand microeconomics of price change. And Lisa, it goes back to the late, great Jack Welch of GE talking about what you do when prices go up.
And here's the mystery, and it's very good that you pointed out the supply-demand dynamic here. What happens if the demand boom wanes? And then you'll have this supply glut, right? That goes to this sort of disinflationary environment. Does that happen, or does demand stay at this level in a new economy that potentially is turbocharged by additional rounds, Tom, of stimulus?
Well, what we're going to see here, we're going to do a data check. I thought it'd be a throwaway before we get to see Michelle. John, unfortunately, it's not a throwaway. A single headline stirring it up. There's great debate about this. We're going to report what we see with the headline, and the fact is the news moved. The Chinese military aircraft entered Taiwan's ADIZ on May 4th. John, it moved the markets.
Seen that headline many times before. Many people have made that point. We've seen this price section many times before. Many people have made that point. It's not our job to say whether something should or should not happen. Here it is. Your equity market's just a little bit lower in the last 20 minutes. Equity futures are off by about 17 points to 4169, and off by about 0.4%. Yields were higher by about a basis point, Tom. We had a break at 160 briefly. Right now on 10s, 160.30.
Dollar strength, euro 120.17. A jumble in foreign exchange. The real yield, negative 0.78 over the last 48 hours, and negative 0.83. Look for that property from John Farrow Friday afternoon. Right now, we've got the perfect guest to get us started in this hour. Seema Shah joins from Principal Global Investments. And Seema, within your note, what I really loved was the linkage, the study of the linkage, rather, between equity and debt. The idea of what the stock market's going to do versus what fixed income is going to do. Describe that linkage right now.
Yeah, I mean, we've been talking about that earlier today. Look, the equity market is looking so strong at the moment. You know, of course, there are concerns that we're not going to get the continued economic surprises, which may keep pushing the market as much as we've seen recently. But it's looking really strong out there. Whereas the bond market, you've got bond yields around the 160 level. It just doesn't seem to be lining up. To me, the main factor which is holding bond yields down is still there's an expectation that the Fed is going to stay on hold. But at some point, I think we're all in agreement here that bond yields are on their way up this year. It's just the speed at which they're going to move, and that's what's going to be the major impact for markets.
Seema, I think one thing that people are struggling with at the moment in the bond market, if this data doesn't get it done, if this data does not translate into higher yields, what data will?
Yeah, to me, it's the inflation data. You know, we need to keep watching that. And the thing is that we're all expecting inflation to move up over the next couple of months. So there's no surprise there. It's really when you start getting into autumn, winter, and if you're still seeing inflation moving up at that pace, that's, I think, when the bond market is really going to freak out. And that's, I think, when the equity market becomes increasingly vulnerable. And the thing is that, look, you know, the market is very, very divided on what the path for inflation is. But I think that even the ones, and I'm going to put ourselves in there included, we do think it's transitory. But we also have to admit that there is a very fair chance that inflation will turn out to be sticky. And that's where all the risks are lying at the moment.
There's a big debate among stock investors of when higher yields is good or when higher yields is bad. Up to a point, it's good. It indicates that people are upgrading their expectations for the economy. At a point that's too high, it reassesses perhaps some of the valuations currently baked into markets. What is that tipping point, Seema?
I think rather than the tipping point, I think it's really that speed. Right, what is driving markets high? And you can look at it, but just looking at financial conditions. Are financial conditions still really, really loose? In which case, the equity market is really fine. It's when you start to see a really turbulent and unsettling move in bond yields, that's when I think markets really start to struggle to digest this. So in terms of a level, it's probably higher than what most people are thinking. It's probably above the 225 level. But if you start to get to yields at about 2% within the next month, of course that's going to freak out markets. So it's all the drivers, it's the speed, which is really the key point here.
Well, the speed is going to go to the first and second derivative. I was talking, Seema, to our Kaylee Lines about this. I mean, just the rates of change out there. Do you expect stability, or do we need to be really, really aware of potential convexity, not only in bonds, but the equivalent convexity in equities?
Look, I think there are risks out there. Look, and that is obviously a risk. But I think a lot of it is going to be down now, at least for the next few months, to the Fed's communication. Where are they telling us that they feel rates are, where they feel about inflation? They have the ability to keep the market calm. But if that starts to unwind, then of course, you know, that speed, that second derivative becomes a very, very key risk. Our view at the moment, though, is that markets are really on a steady upward path. There may be points of pullbacks, but it's really an upward movement from here.
Seema, do you have a regional bias right now outside of the United States? Where is it?
It's an interesting one, actually, because, look, we have really favored the US over the last few months. We have pulled back some of our kind of preference for emerging markets because of all the reasons with COVID, rising inflation, concerns around China. Now, Europe is increasingly becoming more attractive, but I have to say that would be a very tactical trade, because further out, beyond the kind of the joy of reopenings, we still think that Europe is very, very much under pressure from a long-term growth prospect. Until they can get their fiscal policy really moving at the same pace as what we're seeing in the US, which really doesn't look likely, Europe will continue to be the underperformer. So, you know, a few months of maybe good performance from Europe, but then it goes back again. So actually, overall, we still prefer the US.
Seema, I want to just wrap up with dovetailing the conversation that we had earlier this morning with Andrew Slimin into this dialogue. A question of this 11% miss when it comes to Wall Street estimates for earnings so far in the S&P 500. You're getting a little bit more cautious in some of the large cap stocks, or reducing certain allocations, I believe, if I have this right. What do you say to people who say earnings have been blowing it out of the water? Does that make you reassess? Why do you dismiss it?
No, look, there have been a continued upward movement in earnings expectations. Actually, we would anticipate that as the year progresses. You have to be very careful, though, at this point. And this is, again, active management really will do well at this point, because you need to look under the surface, start thinking about which sectors are going to outperform and which ones are going to do badly. You referred to our reduced allocation to large cap tech. We still like mega cap tech, but we just don't think that you're going to see the same kind of returns that we saw last year. But if you're looking at earnings potential, if you're looking at cash flow, those are the companies which are really going to provide stability, not just over the next few months, but actually a longer term. So there is still a place for secular trades within your portfolios, as well as that allocation to cyclicals.
Seema, we've got to leave it there. Seema Shah, Principal Global Investors, Chief Strategist. Lisa, I love the framing of that. It's not an 11% beat, it's a miss. It's the people that make the calls that have missed. That was Andrew Sliman of Morgan Stanley Investment Management a little bit earlier this morning.
Okay, you could say the companies are beating, or you could say that people just haven't gotten it right? I mean, either way, it's the same story, but the idea here is this concept of reassessing human assumption to the bearishness among some people, theoretically, who might feel bearish sometimes.
You're talking about someone specifically?
No, I'm throwing shade at myself.
Okay, I was just wondering if you'd actually say it or not. Tom, we've consistently underappreciated how much we would bounce back and how quickly we would do so. We did that last year, and earlier this year we did it a little bit as well.
Yeah, Ben Laidler over at eToro frames it nicely, John. Can we have 3 consecutive years of double-digit equity return? The answer is we're not supposed to, but he stuck his professional neck out and said, this is unusual. We are going to see 3 years of double-digit return.
It is unique and unusual. And I've mentioned this a couple of times in the last couple of weeks, and I think it's worth mentioning again. This time last year, in the June forecast from the Federal Reserve, they were projecting unemployment to drop back to 5.5% at the end of 2022.
Yeah.
Lisa, that was June 2020. Looking out to the end of 22 of 5.5%. We could see something close to that this Friday, April 21.
And the reason why this has people so nervous is because it speaks to the lack of visibility into inflation, the lack of visibility into some of the beliefs that are across Wall Street that are underpinning a lot of the consensus bets out there. What happens if we're wrong this time around, as we have been so wrong, and I include myself in that, in just how rapid this recovery could be, John?
Well, mea culpa, Lisa. You okay? What's going on?
I mean, it's true.
That's called doing a Steve Roach.
It's true. I mean, honestly, I wasn't expecting things to bounce back that fast.
Everybody's been wrong on this one. And it's the absence of humility that some people are pushing back against right now. And they're pointing the finger at the Federal Reserve at the moment for the lack of humility about how quickly we might bounce back, and maybe they could be wrong. Your average estimate, Tom, as you pointed out, north of $1 million. For the April payrolls report, the median estimate, 995. 2.1 million the high, 700K the low. Your equity market down 21. We're negative 0.5% from New York City alongside Lisa Brabbits, Tom Keene, Jonathan Ferro. On radio, on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Wall Street's march back to its skyscrapers is picking up the pace. Bloomberg's learned that Goldman Sachs is planning to tell its U.S. employees they should be prepared by the middle of next month to work from offices again. That follows J.P. Morgan's mandate last week for a return to offices in rotations starting in July. Pfizer's raised its forecast for fiscal year and said coronavirus vaccine revenue will be much higher than expected. The drug maker expects vaccine sales to hit $26 billion. That's up from a previous estimate of $15 billion. Pfizer's first quarter sales and profit beat estimates. And CVS posted quarter earnings that also beat estimates. The drugstore chain also raised its earnings forecast for the full year. Revenue for its health insurance business was up almost 7%. And in Mexico City, a raised subway track collapsed, plunging train cars with passengers aboard to the ground. At least 23 people were killed and about 70 others injured. The accident is blamed on a broken beam. The subway line that collapsed opened in 2012, and the project suffered from design problems during construction. A fortune valued at $146 billion is at stake in the divorce of Bill and Melinda Gates. The couple announced that they're splitting up after 27 years of marriage. They made no hint of their financial plans, though they emphasized that they will cooperate on continuing their philanthropic operations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
What we are trying to do is to uphold the international rules-based order that our countries have invested so much in. I think the challenge for us is to demonstrate in very concrete ways that we can deliver for our citizens.
That was Antony Blinken there, the U.S. Secretary of State from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. 1 hour and about 12 minutes away from the cash open in New York City this Tuesday. Here's the price action in the equity market. Your equity market on the S&P 500 down 22. We're negative 0.5%. Yields unchanged, 159.77 to 159.95. A breaker 160 in yesterday's session. It holds now. Euro dollar 120.22. We're down there, Tom. About a third of 1%.
As we got earlier with the Pfizer earnings and Dr. Adalja with us with Johns Hopkins, we are again fortunate that Enda Curran joins us, our Chief Asia Economics Correspondent. And the backdrop here is my book of the summer, which is James Stavridis' wonderful 2034. Tom Friedman wrote it up in the New York Times as well, on the stresses of China and Taiwan in the South China Sea out a good 13 years. Enda Curran, moments ago, we had the report. It's a common thing on China aircraft and Taiwanese airspace, and it did move the markets. When we get that headline, does it move the needle of emotion in your Hong Kong?
Well, good morning, Tom. Look, it is another example of why Taiwan is such a flashpoint. These air incursions do seem to be happening with more frequency recently. And China is pushing back against some of the steps that the Biden administration has taken on Taiwan since they came to office. For example, stepping up liaison or making it easier for liaison with Taiwan, sending those former U.S. officials to Taiwan a few weeks ago. So China has been pushing back hard and making clear it continues to push a line that it considers Taiwan to be part of its internal affairs and pushes back against meddling against it. And don't forget, of course, that Taiwan is also right in the middle of this global economic fault line, which is the shortage of semiconductors. So it's of massive strategic importance now, both to the US and the global economy. And China, of course, is trying to advance its own semiconductor technology at the same time. So I think Taiwan is absolutely the global flashpoint between China and the US, and there's no sign of a circuit breaker or that changing anytime soon, Tom.
Triangulate the economics between Beijing, Taipei, Hong Kong, and for that matter, triangulate over to Washington. What's the state of the back and forth, the ebb and flow of that economics?
Hawkish trade policy against China for some years, but now we're getting a sense that perhaps Europe is coming on board that a little bit as well. Our own colleagues today reporting that, for example, the chancelleries and governments of Europe are growing colder in relations with China. There's probably now more reluctance to ratify that investment deal that Europe and China agreed only as recently as January. And on the Pacific front, an interesting example, Tom, is what's happening in Australia. The government there now has announced a review of a China leasehold on a port in Darwin. And that's interesting because that was signed off by all of Australia's top security agencies only 5 years ago. But here we are now where Australia is mulling whether or not that was the right thing to do. There's also tensions continuing to flare with the Philippines over the South China Sea. So I think that China is certainly battling tensions on many fronts with key trading partners and with key economies around the world. It's because this whole trade and technology and human rights tension is now moving beyond just a China-US bilateral thing to more of a global and regional and global, I think, front of many tensions between China and key trading partners.
That's exactly where I wanted to go, and this idea that G7 foreign ministers are meeting in London this week, and a main discussion is some collaboration with how to approach China. What is China's response to the closer alliance between the U.S. and Europe generally with respect to establishing a new dynamic globally with China?
Well, it will be very interesting, Lisa, to see how that plays out. I mean, there's no doubt that there are some among the G7 who are pushing for this kind of alliance, like-minded democracies against China on the economic front and on the human rights front. But there are signs of that isn't fully cohesive either. I mean, New Zealand, for example, has signalled a flag of caution when it comes to the use of, in terms of its own role in backing this alliance against China, in terms of the Five Eyes Intelligence Alliance, for example. It will be interesting to keep an eye on how that develops. As I mentioned earlier, this investment agreement between China and the EU that was signed only in January is now no longer a done deal. And you look at the tensions that are happening with Australia and others that were once, fairly benign economic partners of China. There's no doubt that there is something now of a cooling of relations, and that would, I think, give scope for the G7 to pull together some kind of an alliance on this. But as I say, it's far from a done deal. Germany continues to talk about, for example, the importance of its relationship with China. So there are certainly there's some criticism and pushback, but I don't think there's any kind of a wholesale alliance of the kind that some would argue for.
And we're 7 minutes away from finding out the trade deficit in the United States for the month of March. The expectation is it will be a new record with respect to the trade deficit. A lot of the money going to China, which has been shipping a lot of goods to the United States. How much has the rhetoric not matched with the action when it comes to the economic balance, the economic relationship between the U.S. and China?
Chinese trade to the US is going gangbusters, Lisa. I mean, we speak to manufacturers a lot, and they all tell you that their biggest issue is actually meeting demand from US clients. It's almost as though the trade war never happened. There's no doubt that the big revival on the Chinese industrial and production side of things was driven by the big rebound in the US and continues to be driven by it. In fact, there's been analysis that some of the Biden stimulus will eventually spill over to Chinese companies. So there's no doubt, there is something of a dual track. As you mentioned, we do have on the one level these geopolitical tensions, human rights tensions, security tensions and concerns over technology and the rest. But as you say, the merchandise goods trade between the two world's biggest economy, the US and China, especially from China to US, that's just going gangbusters and going from strength to strength, and it certainly has helped lift China's economy and get it back and to help it on the V-shaped recovery that it has enjoyed since the pandemic broke out a year ago.
And good to see you. you. And as always, thanks for staying late over in Hong Kong. Anna Curran there, Bloomberg's chief Asia economics correspondent. Just to turn to the price action of this morning, about 65 minutes away from the opening bell in New York City. Equities are down 24 points on the S&P 500. Tom, we're down about 0.6%. Your 10-year yield, 159.95. Crude still positive on the day at 65.25, up a little more than 1%. And euro negative, dollar stronger across the board through pretty much all of G10 through the morning so far. Euro dollar 120.23.
In the yield space, I think you see it more, John. The real yield back to 0.84, zero negative. I'll get 3, 2, 1.
You got it. We're live.
Negative 0.84%. There, I nailed it.
Wait, we're restarting the show now?
Yeah, well,
Just right now.
My ability to speak was transitory. Excuse me.
Tom, yield's lower, real yield too. Lisa, interesting that it's the big tech players that haven't got the big boost off the back of that.
Yeah, this idea here that possibly people are worried about higher yields, higher taxes. I don't know.
I feel like we should restart the show every day at 6:01, 6:02, 6:03. Coming up, Ethan Harris, Bank of America Securities global economist. And as Lisa mentioned, just a sprinkle of American data as well, the trade deficit in the United States. From New York City, for our audience worldwide on radio, on TV, this is Bloomberg Surveillance.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How
How do you start your morning?
Guess who won the fight in a commercial break? This black eye you've got right now looks so authentic.
You let him get in a good punch.
Wake up with Bloomberg Surveillance, weekdays on Bloomberg Television.
Hours and 30 minutes ago, this market was on the edge of a snooze fest. As this session has grown older, this session has got a whole lot more interesting. Equity futures are down 25, call it 26 on the S&P 500, negative 0.6%. Your underperformance on a Russell, bottom of the pile, down 1%. The Nasdaq off by 0.9. Bleeding into the bond market, just a little bit of risk aversion. We were north of 160, then we broke 160. Here's the bond market right now, 2s, 10s and 30s on the session. Look a little something like this. Your yields hopefully will come up on the screen. There we are, 159.42. On a 30-year, 227.45. Getting a feel for this market, just a little bit more defensive over the last hour or so. Let's finish on this in the FX market. Euro dollar, break of 120 earlier this morning. Right now, 120.21 and down 1/3%. Dollar stronger against everything in G10. Interesting just to have a quick sneak peek at the FXFC function on the Bloomberg, which just gives you the forecast around some of the major pairings. Euro dollar Q4 21, 122. We're almost there at 120.21. Just how much more work needs to be done here to close that gap between the economies in the United States and Europe, and how do you push it through this FX market? At the moment, people not too bulled up, Tom, on the forecast going into year end.
Yeah, they're not. It ebbs and flows based on the news out of Europe and certainly the pandemic news as well. But there's no question about it. How does Europe respond to a 122 euro if and when we get there? Again, futures negative 23, Dow futures negative 139. Ethan Harris with us, writing herd at Bank of America Securities, their global economist. Dr. Harris, thank you so much for joining us. I want to go to Michelle Meyer's spectacular 2 charts on the makeup of our pain, our jobs pain out of this pandemic. And what she does is she looks at the area underneath the former labor participation rate, and it is an ugly integrand, as the math people call it, that space that we've got to get back to get back to normal. When do we do that?
I don't think we quite recover that whole gap. I think that in the later this year, we'll recover a lot of it. I mean, what's causing the gap, of course, is the COVID crisis is making people reluctant to work. People need to take care of their kids at home. Unemployment benefits are very generous. And there's been very high retirements going on as people kind of rethink their life in a way in this crisis. So a lot of that will come back in the fall and into next year, but there'll be a chunk of lost workers that never come back.
She has a mismatch, 700,000 mismatch, taking this from Bureau of Labor Statistics and CPS data. Okay, fine. Do we get back to a fully employed America? Is that a feasible reach for anything but politicians who are supposed to say that?
Yeah, I mean, we'll get back to full employment, but full employment may not be as low as it was before because you've got these structural problems of job mismatch. I mean, we've seen it in other cycles where you'll have a big shock to the economy. Some sectors grow, others don't. Workers get kind of displaced along the way, and you end up with a higher unemployment rate on a chronic basis. So I think we'll get back to very low unemployment. We probably can get below 4%. But there's going to be a little bit of that structural unemployment that hangs over well into the recovery.
Just want to touch on this data, Ethan. Just give me a second. The trade deficit, the trade balance coming in at $74.4 billion negative, in line with the survey. Mike McKee straight away pointing out that is the widest monthly gap in history of data, going all the way back, Tom Keene, to 1992. That's as wide as it's been for a long, long time. Negative 74.4 billion.
I'm glad you bring it up, John. I missed that. I'm sorry, folks. A little bit of a blur here. Dr. Harris, comment on that, on the trade deficit to GDP.
Another record we didn't want to make. It's obviously the case that the U.S. is coming out of this recession very fast compared to our trading partners. And the growth is in goods demand, which of course is traded. Not in services tend to be domestically delivered. So you've had a massive sucking in of imports. You folks talked about this, China in particular, a big beneficiary of this. And we're not our exports aren't growing quite as gangbusters. So you're going to have a record trade deficit, and it's going to get bigger going forward. It's because the U.S. is so exceptional in terms of the amount of stimulus it's doing.
Well, Ethan, I think that's the story, isn't it? It's a reflection of this massive demand shock that we're experiencing in this country right now that other countries, other nations, other exporters aren't going through. So we're getting all of their exports, and they're not getting none of ours right now because their demands are not there. Europe, a case study for us all to look at.
Yeah, I mean, if you contrast U.S. and Europe, I mean, the amount of fiscal stimulus in the U.S. is 3 times bigger than what they're doing in Europe. Europe has a pretty small next generation of stimulus coming that's spread out over many years. The U.S. has poured massive money in and continues to do it. I think a lot of the stuff that's on the table now will pass. So it's going to, when you way outgrow your trading partners, your own economy is going to look very good, but you're going to pull them along with you. And that's what the U.S. is doing. It's the global engine of growth.
You're going to pull them along with you, or they're going to perhaps weigh you down a little bit as you try to get into a new economic cycle. There has been a huge question about where we are in this economic cycle. There's an idea of burn hotter and shorter. There's an idea perhaps that we never left the old cycle. Where do you fall in this issue?
Well, I think we're going to recover extremely fast. This is going to be, we think, the fastest recovery in history. So we think by, early next year, we're going to be back where we started from. So in a sense, it's almost like this was this kind of bad nightmare 2-year period, and now we're out of it. But there's a danger in this, in that right now, high growth is fantastic. Let's get back to normal as fast as possible. But at some point, we need to slow down. We're going to go through the stop signs next year, I think. And at some point, the Fed needs to change gears. They need to say, okay, we are going to hike, and we're going to hike a little bit more than we're telling you, and we need to slow things down. So it's a remarkably fast recovery. We're jumping from deep recession to full recovery in record time.
Ethan, do you ascribe to the Robert Kaplan idea here that markets themselves, given how exuberant they have gotten, could pose a material risk to the economy in a year or 2 years if the Fed does have to hike more than people are currently pricing in, and there is a quick end to this recovery?
I think there's a risk of that. I think it's a very good point. I mean, right now, the markets are being fed an incredible mix of positive news. You've got Fed not hiking anytime soon. You've got big fiscal stimulus. You've got great growth numbers. Very good news on vaccines and the COVID crisis. So you're going to have a red hot risk asset market for whether it's home prices or equity valuations. But that's an environment where you tend to overshoot. And we could be in an environment where the Fed has to take away the punch bowl. So the risk to the economy in 2023 and 24 is pretty high, I think, of an accident here.
Ethan, with the ties that Bank of America has coast to coast, what do you see for business investment? Is it actually going to affect CapEx, or is it one big share buyback?
No, I think the CapEx is going to be strong. If you look at our surveys of fund managers, they're telling companies invest in CapEx, right? That's a sign of a lot of optimism about the outlook. If you look at models of capital spending that economists estimate, the main driver of CapEx is growth and growth expectations. If a company thinks their market's going to grow, they do CapEx, and it's not really that important, the funding aspect. The funding is kind of something you have to take care of in order to create the CapEx. But the real story is about a rip-roaring recovery, encouraging a lot of investment. So we're going to have a recovery that starts very much concentrated in the consumer as they come out of their cave, their COVID caves, and get out there and engage. And then over time, CapEx is actually going to start outgrowing consumption. That's what we expect next year.
Ethan, just quickly, the guide for Friday. What's the focus for you, away from the headline number?
There isn't any big focus. It's just that this is a ripping labor market. To have another 900,000 plus number I think the story of the job market and the story for the Fed is the consistency of the strength. So are we going to keep getting these big numbers? And at some point, then the Fed has to say, okay, now we need to think about tapering our bond purchases. So it's not so much about one report. It's about the cumulative evidence that this is not a temporary caffeine high. This is a real strong recovery going on.
Ethan, great to catch up. Ethan Harris, Bank of America Securities global economist. As we grapple with a demand shock in the United States of America, and Tom, in many ways, that's what it is, a massive demand shock, which bleeds into potentially an inflation issue, but it's the demand shock we're dealing with, and the supply response is something we're struggling with as well.
You sound like you're doing your ISML theory. Good morning, Michael Spence, studying under John Hicks at Oxford just a few years ago. John, you're absolutely dead on, and what's so important here is it expressed through the price mechanism, or is it expressed through the real economy, as you allude to? And that's a debate. We don't have an answer to that debate, but that comes down to, do you worry about GDP dynamics, or do you worry about price dynamics, or do you worry about both?
Distortions. I think we have to deal with a ton of distortions that are going to take a while, Lisa, to work our way through.
And it makes it really difficult to understand and predict price action. I mean, I'm just thinking, for example, about the trade deficit headlines that just came out. A record trade deficit for the month of March. The dollar, stronger, even versus the UN, even though the U.S. is deepening its deficit with China. The idea here that companies beating expectations by incredible amounts, and yet people are tepid on their shares. Again, John, trying to square what are the fundamentals in a world awash with liquidity.
Yeah, I agree with you, though this was pretty much expected to happen. If you have a demand shock in one part of the world and it's not reflected elsewhere, then you're going to have trade deficits like the one we just saw. What Ethan Harris said that I think is more interesting, Tom, is that this is going to get wider. That's the call that I think is more interesting. Not what just happened now, because I think that's fairly easy to explain. It's what happens in the future. Is this something that stays this wide structurally? A relationship between China and the United States that persists beyond this year.
Well, John, it sets us up for a nuanced June.
A nuanced Tuesday into a nuanced June. Coming up on the Open, Megan Green, Harvard Kennedy School Senior Fellow. Looking forward to that conversation. From New York City this morning, good morning. Lisa Abramowitz, Tom Keene, Jonathan Ferro on radio, on TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rich Gupta. A landmark trial involving the opioid crisis is underway in West Virginia. The biggest drug distributors in the U.S. are accused of swamping a county with millions of doses of painkillers. Lawyers for McKesson, Cardinal Health, and AmerisourceBergen say they shouldn't be held liable. Distributors have proposed a $26 billion global settlement of all opioid suits. The U.S. Treasury more than quadrupled its borrowing estimate for the quarter through June and expects to need about $1.3 trillion over the second half of the fiscal year to pay for new pandemic relief spending. The latest wave of stimulus payments sent the budget deficit to a record in the first half of the year that began last October. Under Armour reported first quarter results that beat estimates. The athletic apparel company also more than doubled its profit forecast for the entire year. Under Armour is being boosted by stimulus checks, the return of team sports, and high demand for athletic gear. And investors are watching Uber and Lyft to see if a bounce back in demand can keep a 6-month rally going. Lyft has risen more than 150% since early November. Uber's up about 64%. Now the question is whether the ride-hailing services can show a profit. Last month, Lyft forecast a profit by the third quarter. Uber aims to be in the black by the end of the year. And Saudi Aramco's profits soared in the first quarter after a recovery in global oil and gas markets. That allowed the world's largest energy firm to keep its quarterly dividend. Almost all of that goes to the Saudi government, and the payout is a vital source of cash.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
I have a hard time with this peak concept, given the magnitude of the earnings revisions and the blowout so far. I'm just not sure we're there yet. And so calling the end or calling the peak, I think is premature.
Good morning, everyone. Andrew Slammin with us there with Morgan Stanley. Optimistic are really pushing against the gloom crew this morning. Lisa Bramwitz and Tom Keene, Bloomberg Surveillance. And right now on the thought of the moment, which is Goldman Sachs saying, let's go, we're coming back in June. Work from home, back to WFO, work from office. Barry Ritholtz joins with Bloomberg Podcast, and of course, some really smart stuff, including an interview with Jonathan Miller. Barry, let me start with that. John Miller's wired into Miami, New York, and about 14 other cities. What did you learn from Jonathan Miller?
So there's, the death of the cities has been greatly exaggerated. There's been a sort of reshuffling of the seats. But people aren't fleeing New York and San Francisco for Florida and Arizona, as those headlines suggest. They're fleeing New York for Brooklyn and Queens. They're fleeing San Francisco for the surrounding environs. Yeah, you definitely have, when you put together those net numbers each month, it's net inflows versus outflows. And while we had a lot of outflows from March of 2020 for at least the next 6 months, remember, inflows were frozen. Right. It was exceedingly different. And now, last month was one of the biggest months in Manhattan real estate in terms of rentals and purchases.
What is price doing? I mean, whenever you have a natural disaster or shock, price adjusts. Give us the Ritholtz take on price dynamics for commercial real estate.
So you have two factors that are interacting at the same time. On the one hand, department stores and offices, we've been wildly overbuilt in department stores for 2 decades compared to either the UK or Germany or Japan. Look at any other Western civilization economy. Much more square footage per capita here than there. So that's going away. Some of it is being replaced with things like WeWork. Some of it is being replaced with logistical hubs and offices. I'm sorry, not offices, warehouses. But the estimate is that we probably have come to the realization that we have about 20% excess office space, much of which is going to be converted to residential over the next 5 or so years. And the thinking is we're looking at a pretty substantial reset, both in supply of housing, if not low-income housing, certainly more affordable housing on both the rental market and the co-op and condo market, because there just hasn't been land to build more. And now suddenly, hey, we have all these buildings, convert them to residential, and bang, there's another 500 people in a building. Yeah. Play that out block after block in big cities, and suddenly there's a lot more residential real estate. P.S. Going through, we reopened our office officially yesterday, and we had a lot of people in. It's kind of shocking how Midtown is still a bit of a ghost town. Yeah. Well, but the surrounding residential areas, they're just popping.
Well, but Barry, that's where I wanted to go. This idea that you did reopen your office and you were pleasantly surprised at just how many people showed up. And you've got Goldman Sachs, you've got JP Morgan setting a schedule for when they expect people back in the office. Is there a feeling among some of the people who you work with that perhaps rumors of the office and the death of it have been greatly exaggerated as well, given the idea that people want to be around other people?
For sure, and there's a couple of things that really stood out. So the 4 partners at Ritholtz Wealth Management said we would come in, and everybody else, it was optional. We were surprised. We had 20 people show up, including my boy Jonathan Novi flew in from Chicago, shocked everybody just to be there. He's been vaccinated for months, so he was comfortable doing that. It's still masks in public places. Everybody in the firm is fully vaccinated. So what you learn is a lot of the work we all do day to day, you can walk into your spare bedroom at home or your office in the office, shut the door and do the work. But that's just your particular work. It's not the work of operating a firm. You have to be able to maintain a corporate culture and have everybody understand the firm's goals and the way we operate. And you have to be able to, we met yesterday for the first time, 2 people we've hired over the past year that we've never met in person. That's like a crazy thing. And it's not easy to hire remotely. Not that it's easy to hire in person. Studies show humans are terrible at that. But it's just fascinating that, oh my God, I just met somebody who's been working for me for 6 months. So it's not that everything is going to change. I think the emphasis on what can only be done together is what we're going to spend more time doing in the office. And the 9 to 5, Monday to Friday routine, you know, that's Brontosaurus burgers. That's old stuff. It'll be fewer hours, fewer days, more people coming and going, but not everybody here every day, morning to night.
Barry, thank you so much. Barry Ritholtz with an important podcast with Jonathan Miller. Look for that here on Real Estate. Within this pandemic, as cities and tri-state area certainly tries to open up. I noticed Florida with comments yesterday as well. Lisa, really an interesting session. You just never know, folks, from beginning of surveillance to end of surveillance. Will Lisa and I be on speaking terms by the end? Bonus round today, the markets got interesting.
They did. I think, again, the interesting factor is we've got analyst after investor after analyst come on this show and say how bullish they are, to say how good the fundamental backdrop is, and yet the bias is still to the downside. And I am struggling with that, Tom. I am struggling with that today, given the fact that we saw perhaps that headline on China and Taiwan that led to it, perhaps some headlines from Ferrari, perhaps just some rumors that started on Twitter that caused the markets to get that much more interesting.
Well, they get that much more interesting, but we're working within very, very narrow ranges here. We really don't have a collective memory of a 10% pullback, an 18% pullback, or every once in a while on a blue moon, Lisa, we enjoy a 35% pullback. We're not there.
But this story dovetails into the idea of going back to the office. This idea that people are exhausted after working from home.
I agree,
and
they're
having
exhausted.
No separation between work and home, and this idea of, what are you doing with your life? What's your culture, et cetera? All of these kinds of ideas. I think it does bleed into the blah nature of markets these days. It's it's harder for people to get excited right now, Tom.
No, the answer is get vaccinated. We're fully vaccinated. We noticed our colleague Francine Lacroix out on social this weekend getting one level of vaccination. She was dressed in a stylish yellow, Lisa. I mean, you and I are showing up in like warmed over Lululemon. Francine Lacroix shows up dressed for the Oscars.
Do you have any Lululemon? Have you ever put on yoga pants?
No,
I would pay.
You'd pay for them.
I would pay. I would buy you drinks. I'll buy everyone drinks.
You'll buy everyone. I'll need a drink if I try that stuff on. VIX 19.41. Where are we in the yield? Yeah, the clock says
Look at
I
those
can
markets.
save myself. How about those markets? Negative 22, down negative 142 as yield. We're watching the 10-year yield, and this is important. It's brokered through a 159.
Yeah.
1.5853 confounds the higher yield crew. On the pandemic, the governor of New Jersey, Philip Murphy, look for that tonight. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data fast.
During this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now, 30 minutes away from the opening bell with equity futures down about 0.5%. Let's get straight to it. We begin with the big issue, monster earnings receiving muted rewards.
The earnings are fantastic.
Undoubtedly an exceptional earnings season.
Amazing numbers, perhaps the strongest season on record.
Consensus forecasts coming into this reporting season have been consistently revised up.
But there is muted reaction because we've come so far so fast.
Some of the responses to earnings
been somewhat muted. More muted. You aren't getting those positive share price reactions.
Between the earnings upgrades and the share price reaction.
Wall Street is not optimistic enough.
So the bar is exceptionally high.
As that cycle matures, I think the bar gets higher.
The bar gets higher. Let's bring in the Bloomberg team, Kelly Lyons and Abigail Doolittle for more. Hey, Kaylee.
Hey, John. Well, the bar was high coming into this earnings season, and yet S&P 500 companies have been able to top even those high expectations. The reports really have been stellar. On average, earnings growth of around 50%, and the upside surprises on average have been about 23%. That is historically quite high. It is not a record. Actually, the beats were larger in the second quarter of 2020, but that was in the thick of the pandemic, and estimates had been revised dramatically lower going into that season. The bar was low. This season, of course, the bar was a lot higher. Now, as for what the beats look like on a sector basis, it is consumer discretionary that is leading the way, topping analyst expectations by about 63%. On average. You also have energy, financials, communications, all topping expectations by 30% or more. Although you have smaller beats for some of the defensives, the likes of utilities and healthcare, they are still beats. That is what is notable about this season, John. All 11 sector groups within the S&P 500, or at least the major ones, have surprised to the upside. And when you look at breadth, we can hop into the terminal and see a chart at GTV Go that shows the percentage of companies within the S&P 500 that have beaten analyst expectations in this quarter. 87%, John. That is the highest on record.
Kaylee, thank you. For more, let's bring in Abigail Doolittle. Hey, Abby.
Hey, John. Well, in terms of the price reaction to those monster quarters put up by companies of all stripes and sizes, muted to sell the news. It's really pretty amazing to see this bearish reaction. And perhaps you could say it is priced in. Since JP Morgan put up the first report on April 14th, you can see the S&P 500 basically stuck in a range overall up about 1.7%. From a chart perspective, though, perhaps looking as though it could pull back down as investors are simply selling these monster reports. If we take a look at it from a sector perspective, the one-day move after great reports, industrials doing the best, up just 0.2%. But the big movers to the downside, that's been in the tech space, of course, technology, the move after, the day after a good report, down 1.5%. Apple, case in point, after putting up a monster quarter, a blowout quarter last week, sales growing by more than 54% year over year. That stock is actually down 4%. Now, there is some reason, John, to think that this has more to do with the macro, whether it is all priced in, valuation or inflation. If we go into the Bloomberg terminal, we're looking at implied correlations here. We see that they're rising. This tells you stocks are moving together as opposed to separately for their own fundamentals. So again, it points to some sort of macro concern on the part of investors, John.
Abby, thank you. Thank you very much. And it's not just been the earnings either, it's been the economic data as well. We talked about this a couple of weeks ago. We had an upside surprise on CPI, on retail sales. What happened to the bond market? It actually rallied. We got a flavour of this in the bond market with the economic data, and now we're seeing a repeat of it with some of the earnings as well. And I think the standout earnings report of the last week or so was what happened with Apple. Knocked it out of Cupertino Park, and what happened to the stock on that day? It finished the day a little bit negative. The team at Morgan Stanley suggesting much of the good news is already baked in. They say the following: beats have outperformed by less than misses have underperformed on the day of results. This negative skew to price action is so far amongst the strongest they've seen since 2007. Joining us now is Megan Green of the Harvard Kennedy School and Invesco's Brian Levitt as well. Megan, do you think simply the bar is just a little bit too high? What do you make of all of this?
Well, so I think it suggests that all the good news has already been priced in and that there might be concerns around that. One concern could be around inflation, which is a conversation I know you've been having for weeks now, whether we'll get more inflation and the Fed will feel like they have to bring forward monetary tightening. Another piece of it could also just be some of the frothiness in the markets. I mean, Elon Musk is hosting Saturday Night Live. If that's not a sign that maybe things have gone a little bit haywire, I'm not sure what is. Cryptocurrencies have done really well, astoundingly well. So there could be some concern on the part of investors that maybe the markets are just looking toppy.
Yeah, the host of SNL wasn't on my dashboard, but maybe it should be, Megan. Brian, your take on the situation as well, please.
I thought you were going to ask me for my take on why I haven't been asked to be the host of SNL
you can take
yet,
a
but I
miss on
assume
that,
that's
Brian.
coming, Jonathan.
You just focus on the markets. I'll assume that's coming for the both of us at some point down the line.
I'm not sure about my comedy chops, but the reality is when we were talking a year ago, investors were wondering why stocks were so robust, even though the economic backdrop wasn't good. So that was a market that was pricing in essentially what we're living through today, which has been incredible economic results and incredible earnings results. So that's how markets work. Markets are forward looking. A lot of this may be priced in, at least for this particular quarter, but I don't want to take a negative view on this. I understand that markets are now assessing whether it's too hot, whether it's inflationary, whether there may be some financial conditions tightening in the market. I understand all that, and that could create some volatility in the markets. But what investors should be assessing is, are we at the later stages of this cycle or at the early stages of this cycle? If you believe, like I do, that any inflationary concerns will be transitory, then you would believe that we are still very much in the early stages of this cycle.
Megan, do you believe it is? That this is the early stage of the cycle and the inflation concerns are the T word that Brian just mentioned and we're all sick of hearing?
Yeah, I do actually believe that. So I do think there are a number of reasons why we're seeing supply side constraints that should be short-lived. And you know, we just saw that our trade deficit hit a record high. That's because we're importing so much. So if we get some inflationary pressures, a lot of it is going to leak out of the country. And I also think it's worth looking a bit forward and seeing what more there is to come. So we've had this ARP that's provided a huge boost to consumers for sure, but we've got a lot more that could potentially be coming down the line. So accommodation isn't being withdrawn from here on out; it's just being added to. So I don't think that we've seen the brunt of the growth that we're going to see from policy.
We've got to work through a demand shock, Brian. It's going to take some time for the supply side of the economy to respond to that. When do you think we'll fully work through some of these distortions? How long do you expect it to take?
I think we're already working through it a bit. I mean, we know that there's some log jams on the goods side. We know that inflation expectations have risen back to levels that we saw the last time the Fed tightened 2015, 2018. It'll take some time. I mean, we have 7.5 million open jobs in this country, so we'll start to get the workers back. I think ultimately what happens is consumer behavior starts to shift. We spent a year sitting in our homes buying stuff. And now we start to move towards buying more experiences and engaging more in the service sector of the economy. And so it provides some time for some of the log jams that exist in the goods sector to start to alleviate. And then we move on to engaging more in the service sector. I think what's critical, everybody's talking about froth. Everybody's talking about this has gone too far, too fast. That's what happens in market cycles. The market goes first. The market prices in all of this, then you start to see it, you grow into those multiples. And our analysis shows us that actually, as you get these nice earnings recoveries, you can start to see the multiples of the stocks come down. And that actually historically has been a very nice place to be as an equity investor. Returns have been quite strong during that environment.
We've been growing into these multiples. Earnings have been getting better. In fact, the forecasts are getting a lift again, not on the EPS side of things, not just that, but also on the price targets on the S&P 500. On the south side, we saw it from Credit Suisse recently, going out to 4,600. Saw it from RBC and Lori Calvasina as well, going to 4,325 from 4,100. Barclays in the mix now too in the last couple of weeks at 4,400 from 4,000 over at Barclays. They're the south side estimates on the S&P 500, Megan. I'm just looking at the economic forecasts from your community, 6.3% for GDP year on the year for 21, for 22 at 4%. Are we done there, Megan? Have we had that big adjustment to what we can expect this year?
Yeah, so I think this year is going to be the highest growth figure that we're going to see. I also don't think that's the most important thing about the economy. So as pent-up demand is being released this year, it's a huge boost to growth. It's worth pointing out that base effects work in both directions. And so, our boost next year should be smaller. Also, the stimulus that's coming down the line is much more medium to long-term in nature. And so it won't be a sugar hit to the economy. The infrastructure plans and the plans to invest in human capital, those are slower burners that should fundamentally boost the economy up to a higher potential growth. So very important, but won't provide that kind of temporary boost to immediate demand that we've been seeing this year.
If you guys can stay close and stand by, I'd love to catch up again. Brian Levitt, Megan Green is going to be sticking with us. Coming up on the program, we're going to run through some of the price pressure and what it means for margins. Before we get there, let's get you some movers ahead of the opening bell. Here's Abby.
John, well, there certainly is a risk-off tone this morning with the NASDAQ 100 futures trading down more than the S&P 500. Before looking at that weakness, we do have two strong earnings movers, Pfizer and CVS both benefiting in a strange way, or an expected way, frankly, from COVID-19. Pfizer beat earnings for the first quarter and sales revenues of nearly $14.6 billion, 7% better than the estimates. They also have boosted the full-year forecast and profit for 2021. CVS has also raised their view as the first quarter beat on testing and vaccination. As for the weakness, though, not surprisingly, it's all about big tech. We take a look at Apple, Microsoft, Amazon, and Alphabet. This is, of course, anywhere between 27 to 50% of the S&P 500 weighting, depending on how you look at it sector-wise. Even more for the NASDAQ 100. These stocks, $6 trillion worth of market cap. It really helps to explain why we have a red day here for futures, John.
Abby, thank you. Coming up on the program, the White House backing Pfizer's move to begin exporting American-made vaccines. That conversation still ahead with Harvard's Megan Green and Invesco's Brian Levitt. From New York City this morning, good morning. About 20 minutes away from the opening bell in New York, equity futures with a move lower on the S&P 500. We're down 24. We're down 0.6%. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I've worked very hard to make sure we have over 600 million doses of vaccine. We're going to continue to make sure that's available. We're going to increase that number across the board as well, so we can also be helping other nations once we take care of all Americans.
President Biden supporting Pfizer as it begins exporting US-made vaccines to shot-starved nations. Pfizer writing in a statement the following: "We will continue to use our global supply chain to ship vaccine doses to governments, delivering on our commitments and ensuring a continued reliable and equitable rollout." For the latest, here's Katie Lyons.
Well, John, I do want to pick it up on Pfizer because, of course, that company reported earnings this morning, and no surprise, they are making a ton of money on the vaccine. I won't get too much into the details. What really matters for the broader inoculation effort is the amount of vaccines the company can produce, and they said it will be $1.6 billion this year in 2021 and raised its manufacturing target to $3 billion for next year. So that's good news for the global inoculation effort, but that effort is going a lot better in some places than in others. Here in the US, for example, where you and I are, in the UK, the majority of people have gotten at least one shot of the vaccine. And here in the US, actually nearly a third are fully vaccinated. That is why here in New York, we are moving toward no more capacity restrictions. You have Goldman Sachs preparing to bring people back in the office next month, but it's a very different story elsewhere. I mean, there's even a discrepancy between Western countries, but the divide between what is happening in the West and the developing world in particular is stark. Of course, India really the poster child for this right now as it continues to have a crisis underway, a humanitarian crisis with cases rising. The average 7-day average of new daily cases is actually now around 400,000, well ahead of what the US saw at its peak. And it's no longer just India, John. A number of developing countries are grappling with this. Laos, for example, has seen new COVID cases jump 22,000% in just the last month, and we're seeing big surges in places like Nepal and Thailand as well. So while it may feel like the pandemic is starting to be over here in the US and elsewhere in the West, it certainly is not, John.
It's very true. Kelly, thank you. Still with us, Harvard's Megan Green and Invesco's Brian Levitt. Megan, I want to talk to you about this reopening and how far we can take this. You've been writing recently about the comparisons, the parallels between the 1920s. Can you push out the boom that far?
Yeah, so I'm skeptical that we can actually push this out that far unless we make fundamental changes to the economy. And their Bidenomics, as loosely defined as it is, can make a real difference. So we can absolutely expect an immediate bounce back in demand. We're seeing that in the GDP figures this year. We can expect the stock market to soar as it did in the 1920s. We're already seeing that. But how long will this last? Will it last a whole decade? That depends on how much is legislated and implemented from the Americans' Jobs Plan and the American Families Plans. And there is some hope that there are some real fundamental attempts to engage in deep infrastructure spending, also investment in human capital, training, education, the kinds of things that economists like me have been screaming about for ages. We're actually finally seeing it on the table. The question is, will it be legislated and can it be implemented? Because these things are all medium to long-term issues. It takes a while for the benefits of this to come. And can the Democrats hold enough of a majority to actually keep this going? Or will the Republicans come back and undo it all? That's the big question.
The spread is so wide as well around what we can expect on a fiscal side over the next 12, 18 months, and of course for infrastructure over the next decade possibly. Brian, when you look at things right now, we're talking about maybe $4 trillion at the high end and maybe zero at the low end if they can't get anything done. How do you plug that in? What happens down in DC for how you see these markets play out?
Well, the first thing I take note of is that, everybody's talking about the $1.9 trillion that has been spent or remains to be spent. And the critical thing is that starts to fade. So for all the talk about, the U.S. economy moving to a higher sustained level of growth, that's probably over-optimistic because for a lot of the money being spent as income replacement, that gets saved. And when you look at polled middle-income Americans, you hear that the expectation is to save, pay down some debt, or invest in the market. So that's not a huge boost to the economy. It's rightfully bridging the economy through this period until we see those vaccine numbers, which are impressive, go up even more. By the time you start thinking about next year, the numbers are large and can certainly be supportive for growth, but take time. I mean, you think about infrastructure. This is not a country that does shovel-ready projects very well. And at the same time, the intent is to raise taxes almost immediately. And so I think you should look at it as there is fiscal support. There's more support than drag, but it's not substantial. And it's why, we mock the word transitory, but part of the reason why we believe that ultimately the U.S. settles into a reasonable expansion, but not a new, higher, sustained level of growth.
Brian, what's the call in the market then? Because in April, we had the everything trade. Every single asset class produced positive returns over the month. Bank of America sticking with the theme. Growth over value, large over small was the story for April. They still believe that value over small, and that cycle has still got legs. It's not over. Do you agree with that, Brian?
I do. I think investors may be hand-wringing too much over it. I mean, the reality is in a recovery phase of a cycle, we know that, credit spreads collapse, small caps do very well, value stocks do very well. As you move towards an expansion phase of a cycle, you tend to see small caps continue to do well and value and growth perform well. I think the way this plays out is, watch the shape of the yield curve. If you get concerns about inflation and you get concerns about earlier than expected policy tightening, growth stocks will do well during that period. If you see, the economy accelerating meaningfully and the yield curve steepening, value stocks. But again, ultimately, if you look back over time, a more expansionary phase of the cycle tends to favor both value and growth. So investors probably don't have to get too caught up in that debate. Improving economy, value will do well. But a lot of the growth stocks have cyclical characteristics as well.
The character of the cycle is important too. Megan Green, your view on that, because that's a big debate amongst economists right now, what this cycle is going to look like. Will it be shorter, hotter, or will it be long and shallow after we come out the other side of this next year or so, in 18 months or so? What's your take at the moment, Megan?
Well, it's worth highlighting first that this downturn has been totally different from any that we've had in our lifetime, that's for sure, but certainly for longer than that. And so the recovery will look different as well. It all comes down to what happens with policy. And there, I think if we do get the American Jobs Plan and the American Families Plan passed through, and also the tax plan passed through, looking like what they do now and sustained, then I think actually we could fundamentally boost our potential growth and could end up being on a higher plane. And so then I think the recovery could be sustained for a longer period of time.
Megan, thank you. We've got to leave it there. Megan Green and Brian Levitt, thank you very much. For anyone that follows football closely, and I'm talking about English football, of course, just some news crossing the Bloomberg that AS Roma has selected Jose Mourinho as its new coach. Of course, Mr. Mourinho fired by Tottenham Hotspurs recently, and AS Roma shares are rallying off the back of it. So Roma has a new coach, and it's Mourinho. That crossing the Bloomberg. And I know you're wondering, why am I doing football? I'm just doing football because it takes my interest and I'm sharing it with you. And I know Tom Keene's in a radio booth somewhere talking about the same thing. Coming up on this programme, the analyst action you need to know. That'll be next in our morning calls. And later, rising inflation fueling record profits. That conversation still ahead with BMO's Brian Bowski and Ashish Shah of Goldman Sachs Asset Management as well. That's where the market, as we count you down to the opening bell, about 8 minutes away. Here's your equity market in the United States of America, 41.61 potentially on S&P 500 futures. We pull back 25 points. We're down around about 0.6% from New York City. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Looking for a big payrolls report this Friday in the United States of America. Here in New York City, going into that this Tuesday, we pulled back just a little bit. We're down 25 on the S&P, 41.61, and down around about 0.6%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Baird downgrading Bank of America to neutral, a 42 price target. The analyst seeing a more balanced risk-reward after its recent rally. That stock is at 40.21 and down about 0.8%. Your second call, next up from the team at Rosenblatt, upgrading Fox to neutral, a $35 price target. The analyst highlighting a number of growth drivers related to streaming. 36.95 on that stock and positive about 0.9% in the pre-market. Your third and final call, it comes from the team over at Goldman Sachs downgrading Kroger to a sell, a $31 price target. The analyst citing potential margin pressure from inflation and competition. That's the story of the moment. 36.32 on that stock, down 2.8% in the pre-market. Coming up on that topic, rising inflation, but record profits on Wall Street. The costs are getting passed on. The margins are holding up. That conversation up next with BMO's Brian Bowski and Ashish Shah of Goldman Sachs Asset Management. From New York City this morning, good morning. 4 minutes away from the opening bell this Tuesday. We pull back just a little bit on the S&P. We're down 24. We're down 0.6%. From New York, this is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Seconds away from the opening bell in New York City this morning. Good morning. Going into that opening bell, equity futures pulling back on the S&P 500, down around about 22 and off by 14 on the Russell. Down 113 on the Nasdaq, down 0.8% there, off by 0.5% on the S&P. There's the opening bell. Switch up the board and let's get to the bond market. Yields look like this. In 2 basis points now, after a rally yesterday, after a downside surprise on both the US ISM and PMI, we're down again to 158 on 10s, a break of 160 in yesterday's session. That break holds. On euro dollar, a break of 120 earlier in the morning. That didn't hold. It was the first time we broke 120 since April 22nd. Right now, 120.18 and down 0.4%. WTI 65, 65.55 and positive by about 1.6%. That is the cross-asset story this Tuesday. With your movers at the market desk, here's Abby.
John, well, it's very clear that yesterday's weakness in tech has continued into today. Tim Bigham of Delta Derivatives yesterday telling me this has everything to do with copper going above 10,000 in London trading, that signals inflation. It's only a matter of time before rates catch up. So today, once again, we have the big tech movers down sharply, weighing more so on the NASDAQ 100, but really, quite frankly, all of the indexes, especially Apple, as you were pointing out earlier, blowout quarter, and this stock is now down about 4% from that report. But if we take a look at other key sectors, we're going to see that banks are lower. This, of course, as yields are down, not hugely down, but down. One reprieve is the big energy space, trading higher with oil. But the risk-off mood, if we were going to gauge it by the Bitcoin complex, the crypto complex, we are going to see it is certainly risk-off. Lots of these names trading lower. Risk-off mood to start the day, John.
As you point out, Abby, it's big tech that's suffering here. About 90 seconds into the session, the Nasdaq off by 0.7, the S&P off by about 0.4%. Try and bring you the sector breakdown just quickly. Energy top of the pile, positive 0.4%. Bottom of the pile is information technology, down by 0.75% on the S&P 500. That's the price action of the moment. The takeaway from earnings, net margins hitting a record high with corporate America fighting inflation by cutting costs and raising prices. Morgan Stanley's Andrew Sliman weighing in, saying the peak may not be in.
There's certainly a risk of margins peaking or being constrained. Could that be overcome by revenues being stronger than expected? That remains to be seen. I have a hard time with this peak concept, given the magnitude of the earnings revisions and the blowout so far. I'm just not sure we're there yet.
Let's bring in Bloomberg's Kelly Lyons for more. Hey, Kaylee.
Hey, John, I'm struggling to think how it could possibly get better from here because we are looking at a record quarter when it comes to profit. And that is despite the fact that inflation and margin pressure has been such a prominent theme this earnings season. In fact, inflation in April mentioned more times on earnings calls than at any other year since 2011, according to Bank of America. You would think that higher input costs that these companies are talking about would put downward pressure on profits, but that is not what we have seen happen. Instead, when you look at blended the profits that we have already gotten this quarter with the ones we have yet to get, the S&P 500 profit is expected to come in at $46.90 a share. That is a record 10% above the previous record set in 2018. Now, when it comes to the margin story, we could very well be looking at a record there. S&P 500 profit margins expected to top 13%. And actually, this is, of course, when all the reports are said and done, the number is expected to be this. But of the reports we've gotten so far, 3/4 of companies have seen their margins expand in the period. And that is because, John, that companies aren't just eating these higher costs. Instead, they are passing them on to their customers. And we're seeing that pricing power being exercised more so in some sectors than others. Ones that are seeing higher demand are able to flex those muscles a little bit more. So as materials, for example, that is leading. It has seen profit up, gaining more than 7.2 times what revenue had gained. For consumer discretionary, that ratio is about 5.88. And for the index overall, we have seen profits come in about 4.5 times higher than sales have, John.
Katie, thank you. Debate at the moment. Inflation talk trending amid a record jump in net margins, with Bank of America running the following. Mentions of inflation are now up nearly 800% year over year, skyrocketing to near record highs from 2011. But record net margins suggest inflation has been manageable so far. Joining us is BMO's Brian Bowski and Goldman's Ashish Shah. Brian, let's just start there. The big focus has been on the cost side, price pressure. Margins are holding up. Do you think they'll continue to do so?
We do. Thank you so much for having us. You know, trying to call a peak in anything is usually a trap, Jonathan.
Yeah.
And this whole notion of calling for peak margins has been a trend in this marketplace for more than 10 years, and it's been the wrong signal. If you go back and look at other reports and things through the Great Recession, it's been a terrible timing mechanism. I think what's happening is a lot of investors, a lot of strategists, a lot of portfolio managers don't know how to pick stocks anymore. They don't know how to build portfolios. They're too quant, they're too macro, and they're too their noses are too deep in the books in terms of academics. And I think earnings are going to go higher. And I think the gentleman from Morgan Stanley, with respect to what his call in terms of the peak is, earnings are going higher, and this is going to continue to go on. Especially the fact, Jonathan, lastly, that companies are just now providing guidance again. So as they continue to unwind that, I think earnings are going to go higher.
Ashish, I want your view on this too, and not just on earnings, but also this concept of peak growth, which we've been grappling with on this program. Is this economy just moving too quickly for people to get their hands around? And is the nature of the cycle bound to just deliver, inevitably going to deliver peak growth almost up front? But I just wonder whether that's even relevant, given where the cycle is going to go. It's very, very early days.
I think you've hit on exactly the issue, which is we're seeing the snapback of the economy really getting back to normal. And then the question is going to be whether this growth continues. I think there's so much focus on the very near term, which is this really V-shaped growth trajectory. It's a V-shaped price trajectory, but it doesn't tell you a lot about what's going to come thereafter. And we think that has yet to be baked, but a lot is being priced in, which actually represents the opportunity both on the bond side and the equity side to make some money.
I want to talk about the credit side in just a moment. Let's start with the equity side though first, Brian, and come to you on that. A lot of people trying to time a market. May comes up and you know what happens when May starts. We have that same conversation we have every May, every single year, every May, and we'll do it again next year too, Brian. Stay invested. Is that your message? Up top, headline.
It really is. No, it really is. And Ashish, by the way, is spot on. I mean, we've seen this whole notion and worrisome about inflation, Jonathan, but yields are down. And yields are down because we frankly think that foreign investors are coming back and buying not only U.S. equities, but U.S. bonds. And I think that's because of the stability of that. So the sell in May go away thing, it's a nice story, but don't let the facts get in the way of a good story, because May typically has been up recently, and we still think that we're going to see choppy, volatile trading. We're not calling for a 10 to 15 to 20% correction like everybody and their mother, brother, sister, cousin, uncle are. But I think you need to be longer-term invested. Stocks are higher a year from now, and oh, by the way, they're a lot higher 5 years from now.
Ashish, the credit market's a different beast. High yield is call constrained. And one thing I'd love to get some insight from you on is just how call constrained high yield is right now, given how much we've rallied over the last 9-10 months.
So the universe in the high yield market is definitely changing. You know, we've had very high levels of issuance as companies took advantage of those calls, refinanced out high coupon debt, and replaced it with lower coupon debt. So we definitely think that we're seeing an extension of that market. The other thing I would highlight is that the high yield market still has a lot of the fallen angels from last year. As we know, the rating agencies can be slow to re-rate many of these issuers, and it represents an opportunity for investors to really take advantage of the improvements in the economy, but while getting some income out of their portfolio.
That's the credit side of the story, Ashish. Just build on the sovereign side for us just quickly. Brian mentioned this. Yields are going lower. Yields are lower again today. And I guess one thing I'm grappling with right now, for all the calls of getting back to 2% and more for the year ahead, Ashish, if we can't do that now with these kind of numbers, when can we do it and what on?
Look, John, you've highlighted the fact that, we've been talking about inflation. Every single client I speak to wants to have a conversation about inflation. What they don't want to talk about is the fact that inflation is actually getting priced into the bond market. When you earn 0% in overnights, everyone, including foreign buyers that Brian highlighted, are looking for yield. And the place to get yield is out the curve. That has brought back a lot of buyers, in the sovereign market as well as in the credit markets or higher quality markets. And in fact, actually, if you think back to the last year, how many months were you thinking about buying bonds? I'd say next to none. We saw most investors actually going after equities, going after high yield. Now's the time to rebalance your portfolio with all these profits you've made on the equity side and actually reintroduce bonds because we don't know what the future has to hold. The market has priced in a lot of good news, and it's a good time to be rebalancing your portfolio.
Let's continue this debate. Ashish Shah is going to stick with us alongside Brian Bowski as well. I want to turn to some of the price action more broadly about 10 minutes into the session. At a market desk, here's Abby.
Well, John, we do have a redhead crossing the Bloomberg right now saying that corn has risen above $7 a bushel for the first time since 2013 on supply worries. Sticking with that theme of rising costs and margins, we have the shares of iRobot and Mosaic both dropping despite having put up solid results. It has everything to do with the idea that perhaps going forward, higher costs, iRobot in particular, warning of higher costs weighing on the forecast from the chip shortage to materials to transportation. Mosaic, analysts saying it was a high bar quarter. They delivered to some extent, but investors wanted more and higher cost weighing. So you can see both of these stocks down sharply. Turning to other movers to the downside, Novavax extending yesterday's 18% loss. They need approval for their vaccine. It's pretty clear that the opportunity in the U.S. Is past them, so it's more of a world situation. Ferrari down 5.4% as they delayed their 2022 targets on COVID-19. And then finally, Plug Power down nearly 6% in sympathy with the poor results from Ballard Power, John.
Abby, thank you. 11 minutes into the session, down more than 1% on the Nasdaq, off by 0.6% on the S&P 500. Coming up, geopolitics. The EU shifting towards President Biden, stirring tensions with China. That conversation up next with BMO's Brian Bowski and Ashish Shah of Goldman Sachs. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
if you can just scan all the incoming mail, all the incoming luggages, it's going to be a massive time saver. And it means that we can capture a lot more of the illegal wildlife trade that's currently going undetected.
So our focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What we are trying to do is to uphold the international rules-based order that our countries have invested so much in. I think the challenge for us is to demonstrate in very concrete ways that we can deliver for our citizens.
Secretary Blinken there pushing back on China, the UK echoing that message, stirring tensions with Europe, strengthening ties to the US.
We also discussed China. I think it's fair to say we eye to eye on the need to stand up for our values, holding Beijing to the commitments that they've made, whether it's in relation to Hong Kong under the joint declaration or wider commitments.
For more, let's bring in Bloomberg's international economics and policy correspondent, Mike McKee. Morning, Mike.
Good morning, John. Well, that was the kind of cooperative attitude we didn't expect to see at the beginning of the year. Remember, the EU and China had signed that investment pact, and they seem to be moving together away from U.S. policy. But that pact hasn't been ratified. And now at that G7 foreign ministers meeting, a chill between the Europeans and China has come about. And that is a big deal. The European Union is a much bigger trading partner with China than the United States. Yes, the entire EU, 27 countries. And they rely on trade for growth, much more so than the U.S. Total volume of $686 billion in trade between the EU and China last year. Anger over policies and the new American administration seems to have helped bring the two sides together, the U.S. and Europe, and put a wedge between Europe and China. Taiwan has become a big issue. We saw a market reaction today when another Chinese jet buzzed Taiwan. Hong Kong, and of course China's attempts to control it. The Uyghurs and what's going on in the Xinjiang province. And China's been slow at economic opening, not living up to all of its promises. So now the European Union's proposing rules to levy fines and block deals targeted at foreign state-owned corporations. In Germany, they've given the chancellor more power over foreign investment aimed at high-tech sectors. The irony of all this, even though it's music to the Biden administration ears, is that our stimulus is helping the Chinese. We saw Chinese trade with the U.S. imports from China grow to a record again this month. Goods imports from China up 6.2 billion to 40.2 billion. Total imports 48.2 billion. These are the biggest jumps since 2013.
Mike, what's the optimal way of reading that data point now, given we're experiencing a demand shock in this country that China's not going through?
Well, at this point, it's just good news for the Chinese because we're filling our empty inventories with Chinese-made goods, and that's what the Chinese would like to see to help boost their economy. The hope is that the rest of the world benefits in the same way as the U.S. spends more money.
It's a big moment for the global economy and for global politics too. Mike, it's great to catch up. Thank you. Some final thoughts now with BMO's Brian Bowski and Ashish Shah of Goldman Sachs Asset Management as well. Brian, you touched on something a little bit earlier about people forgetting about how to put portfolios together. And I mentioned last week that maybe the simple cyclical trade is done. The simple sort of macro trade is done. And I think we got some evidence of that in earnings season where you saw the payback for pull forward in the likes of, say, Pinterest and Netflix, but you didn't see the same thing in Alphabet and Facebook. the stock picking within sectors instead of just sectors versus sectors, factors, styles, Brian. Can you build on that, what you need to be focused on a little bit more in the year ahead?
Yes, and in fact, in our year ahead piece that we published in November of last year, we talked about how we thought 2021 was not going to be this clear trade into normalcy, number one. That number two, that investors should be allocated in a very diversified manner with respect to size and style and sectors. So we're equal weight value and growth heading into 2021, which has been the right call. And we're equal weight small, mid, and large cap stocks as well, because we like to remind investors that the stock market is a market of stocks. It's not just simply buying a sector ETF or buying a style ETF. It's about buying stocks that have the strongest implicit and inherent fundamentals. And I think that's what's winning. Further to that, we ourselves run around $5 billion of money for BMO Private Client, and our portfolios run from 35 to 45 stocks, much more concentrated portfolios. And I think that's the way to do it. And I think I know that active portfolio management is dramatically outperforming. And I think that trend's going to continue for the next several years.
Ashish, I want you to build on this just from the fixed income side, how the conversation has shifted in your mind over the last 6 months.
So I think we've gone from this environment where there was lots of cheap credit, the yield curve was not offering you a ton, to now you have a steep yield curve, but not as much cheapness on the credit side. And so as we look at the markets going forward, a lot of investors make the decision of, do they want duration? Do they want a core plus fund versus to be style pure and a core fund? We think that having core bonds in your portfolio as a ballast to the equities that you have in your portfolio makes a lot of sense right now. That steepness is going to mean that your bonds are going to protect you when your stocks aren't working. And so days like today, it's a nice reminder of why you have bonds in your portfolio, so you can be that opportunistic buyer in the stock market when they sell off.
And you see that move today. We're down 3 basis points on 10s to 156.94. A broad-based sell-off this morning. Big tech leading the way lower. The Nasdaq off by some 1.5%. Brian, it's good to catch up. It's good to see you. My best to you and the team over at BMO. Brian Bowski there. And the same to you, Ashish. My best to you and the team at Goldman Sachs Asset Management, Ashish Shah. Let's get you some sector price action. We do have a little bit of a sell-off in New York about 20 minutes into the session. Here's our stocks editor, Dave Wilson.
Thanks, John. And you've already kind of hit on what's going on with big tech falling in early trading. You look across the 11 main industry groups in the S&P 500, and you see the 3 that are kind of tied into big tech with the biggest declines, specifically information technology. That makes sense. The consumer discretionary category, that includes Amazon.com, as well as Tesla. And then you have communication services, which is where you find Google's owner Alphabet, as well as Facebook. So you're definitely seeing losses, kind of mount in those areas, and everything else kind of going along for the ride, arguably. Beyond that, I'm kind of checking in on what's happening with the food chain, you might say, because we've gotten results, we've gotten analyst calls that kind of tell you what's happening there. I know you've been talking about Mosaic already, fertilizer maker. Shares lower in early trading. First quarter results out late yesterday, and earnings gauge came up short of estimates. And on top of that, even though their inventories are down, they're seeing that in the industry. They're concerned about the effect of higher raw material costs. And bear in mind, the chemicals you make fertilizer with, up more than 50% in some cases this year. Then you have Bunge. We're talking agricultural commodity trading there. So they're a beneficiary of the move in grain prices that sent them to their highest in 8 years. And beyond that, you've got Kroger and Albertsons, the supermarket chains, both cut at Goldman Sachs. Those shares are down.
Dave, good to catch up. We'll continue this conversation tomorrow because once again, got a couple of examples of companies that have delivered beats, upgraded the outlook, and the stocks are negative. Under Armour's one, we're down 1.3%, about 22 minutes into the session. Pfizer's another, down 0.4% after initially being positive in a pre-market, at least, off the back of these numbers. That's an ongoing story, isn't it? You are not getting the rewards for big beats, but you are getting punished for misses. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary as we continue to count you down to Payrolls Friday. From New York City this morning, good morning. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes into the session lows on the Nasdaq off by 1.78%, on the Russell off by 1.9%, on the S&P biggest one-day sell-off since April 22nd, down around about 1 full percentage point now, and led by losses in information technology. We're down by 1.74% on IT on the S&P 500. Even if you deliver a big beat, an upgrade to guidance, I'm thinking Pfizer this morning, Under Armour as well, you are not getting traction in this equity market at the moment. We'll talk about it more through the day, no doubt, on Bloomberg TV and radio. Time now for the trading diary, what you need to be watching through the week ahead. Factory orders and durable goods due at the top of the hour. Fed President's Daily, Kaplan speaking this afternoon, Mester Evans later this week. President Joe Biden giving a speech on the pandemic at 2 p.m. Eastern Time, a Bank of England rate decision on Thursday, and a main event coming on Friday. It is the payrolls report in the United States. From New York City, for our audience worldwide, this was the countdown to the open. Continue the conversation on Twitter at FerroTV. Stay safe. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication?
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself.
So ¿dónde vive acá? En la parte de...
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
And do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay. In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital